Here we're going to get a host of US banks reporting, so that could be something that triggers some new thinking about where the risks and rewards are in these markets. Yesterday we saw actually tech did pretty well as a result of some M&A talk around Microsoft, of course, and that looking more likely. So that's an area of focus for us, and we wait to see whether we get that negativity at the start of trade. The US Bloomberg Dollar Index is down 0.1%. We see some buying of treasuries, the yield coming down a little bit, so that downdraft in response to CPI continues. Let's have a quick look at what's going on the futures picture then for Europe, and I warn you, it doesn't look all that exciting. This is what we have, actually a little more movement than we had just a few minutes ago. FTSE 100 futures down 0.1%, as are CAC 40 futures. Yesterday, the European story was pretty weak as a result of that negativity coming through from China. The numbers from Richemont also consolidating that focus on China and the risks for European consumer goods companies around the Chinese market. So we start trading here in Europe and expecting a little bit of movement downside, but nothing too dramatic. And indeed, that is what we see. So the FTSE 100, the first to open, and it opens fairly flat. There's the move in the dollar that we mentioned just a moment ago. The dollar is down 0.1%, the euro up 0.2%, the pound up 1/10, suggesting a little bit of risk appetite maybe in these markets. But that's where we have seen the direction of travel since Wednesday, isn't it? So since we got that CPI print, which came in dovish, led to a lot of people talking about how much weakness we'll see in the US dollar. And the other side of that is, of course, the opportunity for strength on the euro, the pound, and a host of other currencies. In terms of sovereign debt, we're seeing quite a clear picture coming through here. We're seeing buying of sovereign bonds. We're seeing some of the yields going a little bit lower in an interesting move. And then we see commodities also moving higher. That's a bit of a turnaround from yesterday, where some of the commodities movement was actually lower on the back of that Chinese data. Let's have a look at the sectors then, as more European equity markets open with that sort of lackluster, slight drift downwards in stocks. There's a pretty mixed picture when it comes to the sectors. Technology, basic resources, retail, moving a little bit higher, but some of the sectors that are moving lower, you can see consumer goods companies, energy, food, travel, and leisure. It's a mixed bag. Christina Aquino joins us from our Markets Today blog. Difficult to find a sort of overarching narrative today in the markets, Christine. I wonder if we're waiting for new catalysts. We've got further earnings coming through later on today.
Absolutely, Anna. And yeah, it's going to be interesting. As you mentioned, there's going to be a bunch of banks reporting. All eyes, of course, are going to be on their trading revenues as well as the languishing deals market. Is that still an issue for a lot of these investment banks, especially the biggest players in that deal space, right? And of course, all eyes also on how much banks are really passing on to customers in terms of those higher rates. Does that actually translate into higher savings rate? That's been an issue for a lot of consumers, both in the US and also here in the UK. So it's going to be interesting to see if we see more of that pass-through coming through.
Yeah, that will be interesting. And issues around provisioning for bad debts is going to be something we watch on the consumer, as you point out, whether it's commercial real estate. So that'll be a focus for the bank earnings story. Let's move on to something that comes from Goldman Sachs. And this is some new thinking around the yield curve. Their updated thoughts, this coming from Jan Hatzius. A lot of people worry about the inverted yield curve and worry about what signal that gives on the US economy. Jan Hatzius says, just don't worry about it. What's his argument?
Yeah, absolutely, Anna. And I think, he's espousing this idea that the yield curve has kind of broken down, really, as a recession indicator, right? And the crux of his argument is basically that because of the decades-long quantitative easing that we've seen from a lot of central banks, that is, central banks buying massive amounts of bonds, that's just driven yields across the curve much, much lower, particularly those in the long end. And so it really doesn't take much, for the yield curve curve to invert, markets only really have to price a few rate cuts for us to see that sort of inversion that we're seeing now. And so really his argument is the bond market has been a little bit altered, shall we say, over the last decade. And so yield curve inversions, not as much as a reliable indicator now for recessions. And he, of course, says that he's not even thinking that there's going to be a recession. I think he's more in the soft landing camp, as we say.
Okay, let's think about the bond market and the UK and the costs of raising capital, I suppose, in the UK. Because the big global trend has been, certainly since last Wednesday at least, we've been thinking about lower yields globally. The US Treasury story, of course, driven by the CPI print, and that to some degree impacted what's going on in gilt markets. But then you pointed us towards a really interesting story about UK utilities and the way that they raise money and the debt problems that they have. A day before we get the CPI and RPI numbers, this is an interesting read.
Yeah, absolutely. And I mean, we're looking at Thames Water specifically and how their cost of raising funds, borrowing from markets, has risen 950%. And, I think this is partly because a lot of that debt is linked to inflation, which, as we know, in the UK is quite the problem. 8.7% inflation, that's a headline rate. That's still the highest among G7 economies. RPI even slightly higher than that. And so a lot of these debt that utility companies have that's linked to retail prices, very much in danger because we're just seeing their cost of borrowing surging. And, we've seen something similar for government debt as well. Higher yields in the UK generally have just increased the cost of borrowing for the government. This is something that utility companies in particular are experiencing as well, and really just drives home the point that higher rates in the UK are a problem for everyone.
Christine, thank you very much. Christine Aquino from our Markets Today blog. You can get more from the team that puts together that blog. You'll find it on the front page of the Bloomberg UK website, or you can type TLIV Go into the Bloomberg terminal. That will also take you to the Markets Today blog. Let's check in on the individual stocks that are on the move this morning. Joe Easton joins us with an update. Joe.
So all of these stocks we mentioned in Stocks to Watch are actually rising this morning, and Novartis getting that big share buyback of around $15 billion, pushing up that stock 3% in early trading over in Zurich. Meanwhile, GAM also traded in Switzerland. I mentioned that stock being bought at a 30% premium. We are seeing a little bit of upside in that one, but there is some uncertainty around where the ownership of this company will go with that battle with Lion Trust here in the UK that I mentioned. Ocado, the surprising one, up 5%. What I'm hearing is the commentary around their factory business in the US with partners like Kroger, automated warehouses. That's where the strength is in this report, according to analysts today. We're also going to have a quick look at those Swedish banks that we had earnings from earlier, Swedbank and SEB, both rising in early trading. Those stocks are up around 2%. We brought up SBB, the real estate company, as well. They're getting a bit of a boost, given that these banks haven't announced big property provisions. Meanwhile, speaking of real estate, Vonovia and Legomobilien getting upgrades over at Deutsche Bank. Quite surprising. They say the German real estate market is about to bottom out, turning more positive. We don't get much positive commentary on that space. A little bit of movement up in both of them. Legomobilien coming back down, but do keep an eye on those ones in Germany.
Okay, something to watch there. Joe, thank you very much, Joe Easton from our equities team. Let's tell you what is coming up today. What's in the diary, the trading diary? We're looking ahead to some key economic data out of the US in the early afternoon. We are going to get 1:30 p.m. UK time, a retail sales data out of the US. It's expected to show a 0.5% month-on-month rise in sales. Mark Cudmore alerting us to the way that that index is constructed, suggesting maybe this will be a turning point, or maybe we get another month of strength there. At 2 p.m, US industrial production data is released and may indicate a growing weariness among producers as they brace for waning demand. Throughout the day, we'll be keeping an eye on the US banks that are reporting. We talked about that a little bit with Christine Aquino a moment ago, including Morgan Stanley, BNY Mellon and Bank of America. We will also see the second day of meetings between the EU, Caribbean and Latin American leaders. That is part of their first summit since 2015. Maria Tadeo across that for us over in Brussels. Really interesting talk about access to commodities, of course. And finally, the G20 finance ministers meeting is coming to a close today. There's still plenty of programming coming, though, from India. Several prominent ministers and officials are still to speak, including US Treasury Secretary Janet Yellen. We played you our interview with her a moment, in the last hour. Much more from her then to come, and plenty of other conversations. We will be speaking on this program to the South African finance minister. That conversation coming up shortly. Don't miss our exclusive interview live from the G20 in India. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Markets Today. We are 11 minutes into our European trading day, and European stocks looking a little bit sluggish this morning. We see US futures pointing a little lower as well. E-minis down 0.1% or so, as are NASDAQ futures. Let's get some more of our other top stories this morning on the Bloomberg terminal. Bloomberg has learned that banks are set to be hit with tougher rules on mortgage lending in the United States these rules will go beyond international standards. Regulators are set to release their plans next week for a sweeping overhaul of capital rules, part of the US version of the Basel III Accord that followed the financial crisis. Regulators have already warned big Wall Street banks could face a 20% average increase in overall capital requirements. Morgan Stanley reports second quarter results before the US market opens later, with analysts and investors watching for signs of fees stabilizing and a possible decline in trading revenue from a year earlier. Don't miss our interview with the chairman and CEO of Morgan Stanley, James Gorman. That is at 6:30 p.m. London time. We're also looking ahead to Bank of America second quarter results before the market open. Analysts and investors will be watching for a potential slowdown in loan growth and net interest income. Challenges in pricing for deposits and migration of customer funds could hurt NII, net interest income, of course. We will bring you details as soon as they drop. Plus, Saudi Aramco's CEO Armin Nasser is joining BlackRock's board of directors. Nasser has led the world's biggest oil producer since 2015, including overseeing its public listing. BlackRock's CEO Larry Fink says Nasser's leadership experience, knowledge of the Middle East, and understanding of the global energy industry will make a meaningful contribution. Now, while the European Central Bank projects inflation will slow to 2% by the end of 2025, Governing Council member Ignacio Visco says he thinks it could come down faster than that. He spoke to Bloomberg's Haslinda Armin at the G20 summit in India.
The inflation has been falling in the last months. It has reduced by 5 percentage points since the peak. It is at around 5.5. The news is also a little bit more complicated when we look at underlying inflation. That is, most of the reduction, or all the reduction, is due to energy prices
from having increased massively in 2002, have been also reducing now in the last months, also dramatically. And we have seen in core inflation, in underlying inflation, in the prices of goods and services other than energy and food, we have seen a pass-through of the massive increase in energy prices, especially gas prices, which is the major difference between Europe and the United States, which has been more intense than in the past. And this explains why core inflation is stubborn. At the same time, since we have also been observing a substantial reduction in energy prices, we have to expect that this will be seen also in underlying inflation in the coming months, certainly by the end of the year.
So we've seen inflation go from 10 to 5, but still far away from the 2% target. Well, if inflation does not ease by September, would you support a rate hike?
Well, first of all, it goes from 10 to 5, but it didn't go down further because of the underlying inflation increasing as energy prices are passed through. When they end being passed through and they start reflecting the fall in energy prices, then we will certainly see a substantial reduction. This is in our projections. We project that by the end, the ECB projects that by the end of 2025 there will be 2%. My impression is that it might be faster. What really matters is whether to these still cost push inflation, which may be a little bit complicated what happens in the labor market, which is pretty buoyant, the wages and so on, to these some demand effects may be added. And indeed, what we are observing in Europe these days is that while manufacturing is slowing down or even falling, service sector, especially tourism, is booming in a number of countries, in my country, in France, in Spain.
So on balance, how is the economy doing? Has there been any change since the last time the ECB met?
I don't think that there has been much of a change with respect to our expectations. The transmission of monetary policy takes time. This is not a new thing. I mean, Milton Friedman used to say that monetary policy affects the real economy with long and variable lags. Maybe not that variable, but certainly a bit long. So we still have to be patient and wait for monetary policy to have all its effects on demand.
So the trickle down on the real economy takes time. So having said that, might the ECB be tightening too much? Might you have to perhaps be cognizant that you may have to cut rates even?
Well, my feeling is that first of all, we have been moving from substantial increases in rates at 75 points per meeting to 50 and now to 25. So we are gradually reducing the increase in rates. And I think that what really we have to assess is how long we must remain in this tightened territory. I think we have to be there until we really see that price stability is back. My feeling is that we are on the right track.
That was the Bank of Italy Governor Ignazio Visco there. Coming up on the programme, we'll be back to the G20. We'll be speaking to South Africa's Finance Minister. Enoch Godongwana joins us shortly. Don't miss that exclusive interview live from the G20 in India. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids.
You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Markets Today. We're 20 minutes into the European trading day. A slightly improved picture across European equity markets right now, up 0.1% or so on the Stock 600. Let's turn back to the G20. Finance ministers and central bank governors are discussing food, energy security, debt distress at their meeting in India this week. Inflation is another key theme, of course, with global policymakers talking about diverging approaches to the issue. Bloomberg's Menka Doshi joins us once again from the summit. With a guest. Menka.
Good afternoon. Thank you very much. I'm joined by the Finance Minister of South Africa, Enoch Godongwana. Thank you very much, sir, for your time this morning, or rather afternoon. Let me start by beginning. This is the ultimate day of this meeting. In what specific areas do you think maximum progress has been achieved at this G20 meeting?
I think in this G20 meeting, unlike last year, we are moving quite closer to each other on a number of topics. Among other things, for instance, the broadly general consensus on fast-tracking the debt relief program in terms of the common framework agreed in the G20. Okay. A case in point has been the success in dealing with the Zambian solution, and we hope that an MOU will be signed soon. So we're also kind of on a road to Marrakesh, kind of agreeing on the broader strategic direction in relation to the evolution of the multinational development banks.
Right.
So, as part of the international financial architecture. So, there's much progress.
When you spoke of debt relief, can you elaborate on whether China has been part of that consensus that is coming together on being able to move faster when it comes to other countries after Zambia?
Look, China has been part of the agreement. Mind you, in the case of Zambia, China and France co-chaired. We were kind of a vice chair of both. So they were part of the deal. And I think now we need to, creditors have got to meet and deal with Ghana.
And China will be part of that conversation as well?
China will be part of that conversation.
All right. Because there seems to be the concern that maybe China was an unwilling or reluctant partner to what took place in Zambia, and therefore it might not be easy to repeat with other countries.
There are a couple of challenges. Among the challenges is the notion that this kind of process of haircut must not only be sovereign, including multinational development institutions must do the same. I think that's the kind of angle China is pursuing. And largely, they also face a bigger exposure than everybody else. So the sensitivity from their side would be understandable.
Minister, do you expect that we will end this G20 meeting with a communique, or does the standoff on the use of the terminology for the Ukraine war continue, and we will end with only a summary this time?
The chairperson of the meeting has not indicated anything in that direction, that there will be no communique. If there's no communique, we are likely to have a chairperson statement, which has been a tradition now since April last year.
Okay. Let me shift focus to the South African economy. Growth has been a challenge this year. There have been downward revisions to growth estimates through the course of this, calendar year and in the fiscal year. Do you have a revised estimate for growth? What are you hoping that this fiscal year will end on?
The interesting thing is that everybody who's looking at the South African economy, they would disagree on the numbers, depending on how they are penciling in the electricity outages. For instance, the central bank was down, they've revised theirs upwards. I suspect we'll revise ours downwards. And that number we can only finalize when we go to the October.
You expect that the government will revise its GDP estimate downwards?
From where we were in February.
Because of the electricity cuts?
Electricity cuts. However, there has been the fluctuations, which make it difficult to firm a number, which we will firm it as we go into the medium-term budgetary policy statement in October.
Can you give me an approximation of how much that downward revision could likely be?
No.
But the electricity situation has improved in the last
The electricity improvement has improved in the last few weeks, except in the last 2 days.
Except in the last 2 days. I must also ask you about the challenge posed by inflation. Now, it seems that the governing African National Congress has asked your government to hold talks with the central bank about using other measures to curb inflation. Are you in conversation with the central bank? What kind of other measures could be deployed? No.
I'm not in discussion with the central bank on that matter. The central bank in South Africa, by constitution,
is independent.
And its purpose is defined as that of protecting the value of the currency in the interest of balanced growth. Now, they are required to be in consultation with the Minister responsible for finances, but it doesn't mean the Minister responsible for finances can tell them what to do.
So you don't have any suggestions either on the inflation band that the central bank attempts to adhere to, or on the tools that it can deploy?
The band is a debatable issue. The last time it was effected, inflation targeting, was by a policy by government, not by the central bank.
And do you expect that might change in the next few months or so?
No.
So it stays at between 3 to 6%?
Yeah.
All right. You also recently led a delegation of ministers to the U.S. to talk about trade. There is, some interest in what the potential outcomes were of that. Can you detail some specific outcomes from that meeting?
I can't detail a specific outcome because together with the colleagues, we're trying to generate a report which will say what are the specific outcomes, because we met a variety of agencies, both in the legislature and in government. And we're beginning to say, what did that tell us? But broadly I can say, we met an audience that says, look, we love South Africa, okay? But there are certain irritations which we need to sort out. Like in any other marriage, sometimes you do irritate each other. So that's the impression I got.
So you're not concerned about an end to the preferential access that South Africa has? This comes up for review next year, I understand. Will it continue? Will it not continue? What are your fears around that?
I don't think there's a general firm decision that says we should not continue. As I indicated to you, there were concerns about a number of things, including the vessel that docked in Cape Town, including a posture which our colleagues in the USA think we have of what they call an anti-American posture, which is, again, is not the accurate concept.
Minister, you leave me in suspense. Do you expect the preferential treatment when it comes up for review next year, to continue or not, based on your most recent conversation?
Look, based on our conservation, there's no reason to believe that it won't continue.
Minister, thank you so much for your time here at the G20 meeting in Gujarat in India, and thank you for speaking to Bloomberg.
Thank you.
Anna, it's back to you.
Menka, thank you very much. Menka Doshi speaking exclusively with the South African finance minister at the G20 summit in India. Really interesting conversation about where growth goes, their expectations around growth, where CPI goes in a South African context, and the geopolitics, of course, on display at the G20. Later in the show, we will head back to the G20 summit in India. We'll be speaking with the Dutch Central Bank chief, Klaas Knot. That conversation with the IMF managing director, Kristalina Georgieva, also coming up a little bit later on in programming. Let's get back to the markets then and check in on where we are on the European equity trading day. Welcome to markets today. We're half an hour into Tuesday's session, and you can see that the DAX underperforms a little. Elsewhere, we see a little bit of gains for markets, up 0.1% on the London market, the DAX down 1/10, so no big moves. The CAC 40 fairly flat this hour. We, of course, saw some substantial losses on some European equity markets as a result of China concerns plaguing consumer-facing businesses yesterday. So that was yesterday's story. Today, we seem to be without a catalyst. We've digested the China story, looking ahead to the US bank earnings season and waiting for further moves. Let's have a look at the sector breakdown a little bit then this morning and see whether we can glean anything of interest. We are almost almost evenly divided between those sectors going higher and those going lower today. Telecoms is the worst performing sector, down by 1.2%. Banks and energy also underperform. Healthcare is a strong performer, as is basic resources, so not necessarily a very clean sort of risk on or risk off picture coming through on these markets. Fairly muted moves. Joe Easton from our equities team is here to help me out, trying to tell some more interesting stories about what's going on in these markets today. Joe, it's a little quiet out there, but you found some interesting movers.
So these are the biggest movers today, Anna, in terms of the gainers. Ocado, the big focus in the UK here, up 11% now, extending those gains in the last few minutes. The latest notes I've been reading have been talking about strength in their partnership with Marks & Spencer, their online retail venture. Marks & Spencer stock also gaining around 2% on the FTSE 100. Meanwhile, Novartis up 3%. They've got that big share buyback. $15 billion will be returned to investors amid strength in cancer and immunotherapy. Also in the pharma space, we brought up Swedish Orphan Bio. We don't look at that one too much, but that's up 5%. They do immunotherapy, got some strong results out of Stockholm today. Meanwhile, TransferWise, this is a stock that really got slammed after its IPO, but has reported around £29 billion worth of volume in terms of money transferred across borders in the last quarter. That one up 3%. Now, in terms of losers, it's the telecom space, which is really weak today. Over in Stockholm, Tele2 down almost 10% now. They've had to increase some of their capex, their capital expenditure, in order to push up growth. That's also hit their peer Telia. Meanwhile, in London, Hargreaves Lansdown dropping ahead of earnings tomorrow. Some concerns that retail investors won't put their money into stocks and shares, ISAs, things like that. They'll just simply stick it in a bank account and take those interest rate rises. Finally, SFS, this is over in Switzerland. That's an engineering and materials company. Some poor numbers. We're also going to have a look at a couple of banks. It was the Scandi banks that are in focus this week, Swedbank and SEB. They were both rising earlier, both pretty much unchanged, up a tiny bit. But the Swedbank CEO spoke to the show earlier. Have a listen to what he had to say.
the margin on mortgages are going down in a tough environment where a lot of Swedes, Estonians, Latvians, Lithuanians are under pressure. But we've also seen that the deposit margins are doing good. And altogether, we see that net interest income goes up 7%. And the key point is to have a competitive offer that suits our customers. And we have that.
How do you have that besides, again, just giving savers more? What else are you doing there?
Well, I'll give you an example. So in Sweden, on a transaction account, you get 0.25. On an easy savings account, you get 1.85. And if you lock in the money for a year, you get over 4%. And in Estonia, Latvia, Lithuania, you can get over 4% by locking it in 3 months. So it's a very good and competitive offer to our customers.
So does that mean you don't really see a peak in net interest income? Can it just keep on gaining?
Well, we don't do forecasts on individual lines, but the key point is that we deliver a return on equity of 20.4%. And our long-term goal is to have a sustainable return of equity of 15% or more. So that means that we expect rates to be high for longer. But of course, when interest rates go down, we will be closer to our long-term strategic idea of having 15% return on equity.
Taking a step back, Jens, if you are expecting a higher for longer environment, does that make you concerned about the economy? Can the Nordics, can the Baltics, can they continue to handle higher interest rates for this year and potentially next year?
Well, if you look on the Swedish economy is seeing negative growth this year of, let's say, 0.5% to 1% negative. But I think what needs to happen is that it needs to be a bit weaker before it can start going again, because inflation has been rather persistent in Sweden, and we have too high inflation. And when you listen to the IMF, they are very clear that take drastic measures to push down the inflation so it doesn't stay on that level.
So that was the Swedbank CEO, Jens Henriksson, speaking to Bloomberg earlier. As I say, Swedbank shares now pretty much unchanged, but the Scandi banks setting the tone in terms of banking earnings. We will see a bunch of other banks reporting over the next few weeks, including here in the UK and in Europe. That will once again be a key focus of the reporting season, Anna.
Joe, thanks very much. Joe Easton from our equities team with some of the earnings themes and other movers on the markets. He's focused at the larger cap end of things. Let me just bring up one FTSE 250 business that's also on the move. Darktrace, the cybersecurity firm listed in London. Substantial gains for this firm. The stock is up by 24% in this morning's trading session. The company's saying that an independent review by Ernst & Young didn't find issues in its processes that weren't already known to the company, and it won't have to restate any financial releases as a result. This all, of course, after a short seller earlier this year questioned the company's accounting practices, but no changes needed then to its accounting as a result of this. So we'll leave Darktrace there. Let's turn to other matters focused on the UK. Jim Ratcliffe is chasing one of the biggest trophy assets in sport, Manchester United Football Club, of course. The problem for the self-made billionaire from the north of England is that he's competing against a royal from a Gulf state with a $450 billion sovereign wealth fund to play with. Let us get to Bloomberg's deals reporter, Farid Saloul, who joins us with analysis on this story. Farid, very nice to have you with us. So let's start with why these people want to buy Manchester United. Why does Jim Ratcliffe want to buy it?
Good morning, Anna. Well, so we're talking here about the biggest brand in world football, which as an Arsenal fan pains me to admit, but I think...
And I was going to say, is that still the case?
I think so, despite the recent underperformance.
Yeah,
you could easily make that case. And so for anyone with the means, opportunity and the will to pursue sporting assets, it's kind of a no-brainer to go after. And we know Jim Ratcliffe has the means. He's, made his fortune as the founder of petrochemicals company INEOS. He's worth about $16+ billion. And we know he has the will. He's been investing more of his money of late in sporting assets, most notably a professional cycling team. He also has some stakes in football clubs in France and Switzerland, and also the Mercedes Formula One team. So Manchester United would be the jewel in the crown of that portfolio.
Okay, what is it that fans want, and why is this taking so long to get done?
So fans want, first and foremost, the Glazer family out of Manchester United. They've owned them now for quite some time. They've saddled the club with debt. They've presided over a period of underperformance. So get them out. That's point one. They like the idea of the rival bid from Qatar because it clears their debt and brings the promise of millions of spending on new players and infrastructure, etc. Jim Ratcliffe is also promising those things, but crucially, he's only after a majority of the club in a deal that potentially allows some of the Glazers to remain. So from a fan's point of view, I think they would prefer the Qataris to take over.
Okay, interesting. We will keep watching, of course. Thank you very much, Fareed, for bringing us the story. Bloomberg's deals editor, Fareed Salul, with the latest on Manchester United and the battle for it. Coming up, we'll be back to talking monetary policy and the macro environment. We'll be joined by the Financial Stability Board Chair and Dutch Central Bank Chief Klaus Knot. Don't miss that exclusive interview live from the G20 Summit in India. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Markets Today. We're 42 minutes into today's market session here in Europe, and European equity markets pretty unchanged, as you can see there. In fact, entirely unchanged on the Stock 600 this hour. Let's return to the G20 in India, where finance ministers and central bank governors are meeting this week. Plenty on the agenda, from debt distress to global inflation. Bloomberg's chief international correspondent Hans-Linda Armin joins us now from the summit with another guest.
And those issues include regulating cryptocurrencies, a huge issue here at the G20. And the Financial Stability Board has come up with some recommendations. Its chair joins us right now. Klaus Knot, thank you so much for joining us. I mean, you're recommending that perhaps authorities should cooperate across borders. Now, the problem is there are few jurisdictions with actual crypto regimes. That makes it really complicated.
Yeah, but that is exactly the reason why we have now come up with these global standards, which will be subscribed to by all the members, and that now will have to be rolled out globally, so beyond the membership. Obviously, the G20 membership needs to lead by example, but these rules can only work if they're applied and implemented globally, and that's why we will also have a peer review, reviewing the way these rules have been implemented, scheduled for 2025.
It is about an oversight. You talk about having that in place by 2025, but between now and then, a lot of things can go wrong. We have seen repeated scandals, FTX case in point. I mean, what kind of assumptions are you making in terms of scandals, things that could go wrong between now and then?
Yeah, but let's not forget that crypto has never acted in a sort of regulatory vacuum, right? There are rules in place, actually. What we have been doing is accentuating these rules for the economic functions that are conducted by these cryptos. But these functions are not all that different from traditional financial activities, and such activities are regulated. It's same activity, same risk, same regulation. That's the underlying principle of the standards that we put out. The industry is in a rapid evaluation, but so will the rules.
We have authorities, central banks at different stages. Some embrace it, some don't. How do you get everybody on board at the same place?
Well, we really have to create a culture of cross-border cooperation, a habit of cross-border cooperation that is even stronger in this area than it has been before in other areas. Because this is truly borderless business. And the chain is as strong as the weakest link. So we have to make sure that implementation becomes a global effort. And we have to make sure that we put also a lot of global monitoring on it and make sure that these rules are indeed enforced. Now, luckily, some of the major jurisdictions have not been sitting still. They already developed some jurisdictional approaches to it. So there are some best practices that are actually already developing as we speak. And we have to make sure that they get rolled out across the globe as quickly and as decisively as possible.
Your recommendations emphasize a lot on governance, but very little on transparency. When you take a look at ownership, very few people actually have a big ownership of some of these cryptocurrencies and crypto business, the likes of CZ, the likes of SBF, the likes of Justin Sun. I mean, should there be greater transparency, and should that be reported to the regulators?
Oh, yes, absolutely. But I would argue that data availability and disclosures is an integral part of the regulatory regime that we have been designing. Yes, it is about governance, it is about avoiding conflict of interest, it is about segregation of funds, client funds from company funds and what have you. But transparency and disclosure is an integral part of it. Investing in crypto is a risky activity. We do not necessarily want to prohibit citizens from investing in risky assets, but we do want them to understand the risks that they are investing in, and transparency and disclosure is an integral part of that equation.
Stablecoins, we have the SEC banning Binance USD, but now there's a lot of talk about perhaps a euro stable, a yen stable. Is that worrying for you?
Well, it is not worrying in the sense that we now have this regulatory regime for global stablecoin arrangements. So if these stablecoins were to develop, and let me emphasize that as of today, none of the existing stablecoins comes even close to the requirements of global stablecoin arrangements. But if they were to develop, now we would have the regulatory umbrella in place, and individual jurisdictions could very quickly identify such stablecoins as qualifying and being brought under the regulatory umbrella.
What's your biggest concern right now when it comes to cryptocurrencies and regulating cryptos?
Well, of course, I am sort of very much focused now on a rapid implementation, a global implementation, global cooperation arrangements, information sharing. But if we get that off the ground, I'm convinced that we can significantly contain any potential financial stability risks coming out of this industry. So far, the industry is relatively contained. So far, the direct linkages with the traditional financial industry have been contained. But I think it is our effort to keep it at that and make sure that some sort of hidden systemic risks don't get the opportunity to build under the radar screen before we can see and observe it.
Mr. Knott, you're also the president of the Netherlands Central Bank. Let's talk about inflation. Has inflation peaked in the Eurozone?
Well, I would sincerely hope so, but before sort of taking such a decisive stance, I clearly would need to see more tangible evidence. It looks as if underlying inflation has plateaued, But in the coming months, we would then want to see a bit more sort of decisive evidence on it actively coming down. In our projections, we have inflation not coming down to 2% until the very end of 2025. To me, that is the bare minimum in terms of disinflation that we will have to engineer. So we have to very carefully watch the risks surrounding this baseline. And so far, inflation persistence has surprised us a few times. Let's hope that process is coming to an end.
Paolo Gentiloni says 2% might come in 2024, not 2025. Do you agree? Might it?
Well, that's an optimistic view. But
Do you share that optimistic view?
Well, I would say that there are risks on either side of the balance, either side of the baseline projection. Let's just watch what the data will tell us in the coming month. I've been saying before that I'm convinced that even to protect this baseline, we will need to hike in July again. But from July onward, I think we have to carefully watch what the data tells us on the distribution of risks surrounding the baseline. So far, we've been mainly preoccupied by the risk of inflation persistence. But it is, of course, true, the more and more hikes you get out of the door, so to speak, this balance of risk is gradually shifting. And also the risks of perhaps doing too much needs to be paid more attention to.
If inflation does not ease by September, would you vote for another rate hike, or is
that is impossible to say, because we still have a lot of relevant data points coming out in between now and September. Again, for July, I think it is a necessity. For anything beyond July, it would at most be a possibility, but by no means a certainty.
Klaus Knott, we thank you so much for your insights today. There you have it, Klaus Knott of the Financial Stability Board. Anna, he says, you got to err on the side of caution.
Thank you.
Thank you very much. Thanks to Bloomberg's chief international correspondent, Linda Armin, speaking exclusively there to Klaus Knott, as she said. Also the Dutch Central Bank chief, of course, and he did go on to say that the July hike from the ECB, that he will see as necessary. He sees that as necessary, but there's a lot of data due before now in September, so can't say whether September will see another hike. Coming up, we will get back to the US bank earnings story. We're going to be hearing from a number of lenders today. Lenders giving us their conclusions around their performance, of course, but also some commentary around capital rules and changing regulations in the US. This is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Markets Today, 53 minutes into a fairly quiet session here in Europe, and you can see European stocks actually making modest gains, up 0.1%, the FTSE 100 on par. With that, the DAX underperforms a little. Let's get to what is ahead. Morgan Stanley and Bank of America report earnings for the second quarter today. Investors will be scrutinizing deposits as well as a slowdown in deal making and potential trading declines. Also, Bloomberg has learned that the three big US financial regulators are expected to release their plans for a sweeping overhaul of the capital rules of US banks next week. Joining us now with a look ahead is Bloomberg's Valerie Teitel with analysis. Valerie, good morning. So, good morning once again, I should say. Let's talk about what to expect from bank earnings firstly.
Yes, we have a lot today. Bank of America and Morgan Stanley are the big ones, but we also hear for some regional banks. We get PNC, Western Alliance, and Schwab. For the regional banks, the focus is mostly going to be on deposit outflows. Hopefully, they have continued to slow. But for the big ones, Bank of America, a big lender when it comes to the U.S., the key metric there will be on loan growth and their net interest margin. This chart on screen details their net interest income. The reason why that's in focus, Anna, is because it has peaked in the Q4 of last year, and it has fallen in the first quarter. Analysts expect it to fall again in the second quarter. This is all down to rising deposit costs. You're having these bigger lenders actually having to pay up to keep deposits while they're still maintaining a higher yield on their loan portfolio. But does that pressure on net interest income continue? For Morgan Stanley, a bit of a niche investment bank, we're going to be looking more closely on their fees, their investment banking fees. Morgan Stanley has been in the headlines recently with a lot of job cuts, signaling a bit more pessimistic view when it comes to their capital markets revenue. Maybe we see some of that today in their earnings. And then any decline in trading revenue from Morgan Stanley. They're a big trading house, especially when it comes to equities. The second quarter has overall been a bit less volatile, so perhaps a decline in the trading revenue.
So those big investment banking themes in focus, but really interesting, that competition for deposits that even the big banks are having to play now against other places you can put your money. Let me ask about the change in regulation that's coming. What do we know ahead of next week?
The news overnight, Bloomberg saw the latest draft of these rules, which included stricter capital requirements when it comes to mortgage lending. Now, this is a new focus, something we have not heard of before. And the thing that was interesting seen in this draft was the proposed risk weights on the capital requirements on these mortgage portfolios is way higher than the Basel III framework. So again, that just makes us a bit more worried that perhaps these proposed rules we hear on July 27th will be a lot stricter than the international framework.
Valerie, thank you very much. Our colleague Valerie Teitel with the latest on the banking sector. Quick mention of the European bond market. We're seeing German bonds on the rise after the ECB's Klaus Knot. In that interview with my colleague over at the G20, his Linda Armin in India, those German bonds rising after the ECB's Knot signals optimism on inflation. We see a yield of 2.4% on the German 10-year right now. That is it for Markets Today. More insights coming up on the Pulse next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. And market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manus Cranny in Dubai. Here's what's coming up on today's program. The bond rally extends for a second day. The bet that global central banks are nearing the end of their aggressive streak of rate increases. European stocks are flat. Treasury Secretary Janet Yellen says China's economic slowdown risks causing ripple effects across the globe, but doesn't expect a U.S. recession. We'll bring you our exclusive interview. Plus, G20 finance ministers and central bank governors concluded a two-day gathering in India with participants haggling over debt relief for developing nations. Very good morning, warm welcome to the show. Sitting in for Francine today. This is State of Play across the assets. The NASDAQ is no longer partying like it's 1999. Goldilocks is in charge overall in terms of risk, but you are just seeing this moment of reprieve as Janet Yellen says the U.S. will skirt recession, and Goldman Sachs reduced the odds of a recession in the United States to 20%. 10-year yields drop a little bit lower. I mean, this momentum in the bond market is really quite reflective. We put on 2.3% in the bond market last week, the best week since November of last year. And it wasn't just sovereigns, but high yield and investment grade, all propelling to the upside. Gold is up. If you have a global deflation narrative as you have in China, where do you want to be? Do you want to be in bonds? Do you want to be in gold? The dollar rolls down ever so slightly, but again, the view is that to deliver further dollar weakness, you got to be pretty darn sure that the growth story in the world really takes a leg to the upside. This is a mixed opening for European stocks. At the bottom of your screen, you're going to see Ocado come up. You've got a pretty good presentation from them. They're shifting squarely and strongly to profitability. The stock is now up over 10% at one juncture the last time I checked in. First half loss and the EBITDA loss will be $2.5 million. That's severely below the original estimate of just under 9 million. You can see the stock pumping away, up 13%. So the European map just looks hesitant, one could say, because you've got these growth forecasts for China being downgraded. More of that in just a moment. One thing to note is, of course, the propensity to own banks. This is what we're going to discuss over the next hour, which is how injurious are the new regulations in terms of capital requirements? How injurious is it going to be in terms of net interest income running out of puff? We'll bring those stories to you as we go through the morning. But the bond market, as I say, the rally is enduring. European stocks are mixed. Equities in Asia dipped in Hong Kong. And they sort of played catch-up, really, with a weaker-than-expected Chinese economic growth story. The U.S. Treasury Secretary spoke exclusively to Bloomberg about China's economic slowdown and the risk it poses.
Slow growth in China can have some negative spillovers. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession.
The magic words. I don't expect a recession. Christina Aquino is with us. Christina, great conversation between Anne-Marie and Treasury Secretary. It's interesting. She wants to put a floor under the macro between China and the United States of America. But it is important that she now calls a moment of where they may not crush the jobs market to tame inflation.
Yeah, absolutely, man. It's quite interesting because you can really see the two sides of Janet Yellen in that interview, right? We have Janet Yellen, the Treasury Secretary, really wanting to spark some calm over the prospect of the U.S. economy. She really doesn't want to spark alarm over a recession. She's saying herself that she's not seeing a recession, but then you can see the economist Janet Yellen still wanting to kind of walk that line, right? Like she doesn't really want to say anything too definitive. Really, the most that we got from her is the idea that no, we're not going to hit a recession. But as far as the U.S. economic slowdown is concerned, that's still kind of the jury's out still when it comes to that madness.
And then, of course, we have this cascade down on the estimates for Chinese growth coming in at the 5% level. And a lot of people had hoped that, well, that was a guide level or a floor level that the Chinese might deliver. But it looks as if it's becoming a consensus.
Yeah, you're absolutely right, Manus. And I think the nuance here in terms of big banks downgrading their China forecast. So 5% growth, that's still in line with what the government itself is forecasting. But I think the negative here is that a lot of banks are saying that's now the ceiling, as you mentioned, Manus. It used to be the floor, it's now the ceiling that they're seeing. And there's potential for those growth forecasts to be downgraded further from here. And, you know, we have seen a spate of negative economic data coming out of China. It's just consistently disappointed to the downside. Perhaps the silver lining here, though, is that calls for stimulus very much growing louder. And so if you do see more details on that, more of a concerted effort from the Chinese authorities, that could potentially turn the China growth story around and make investors and economists a bit more positive on China.
Christine, always good to get your insight on that. Let's just see where the consensus number comes. PBOC to the rescue, I say. Christina Aquino, managing editor in London. Let's turn our attention to the G20. We've been busy, where China has really been the focus. The U.S. Treasury Secretary, Janet Yellen, she said in Beijing has failed to address the unfair trade practices that led Washington to impose tariff hikes on the country.
We're undergoing a 4-year required review of tariffs. We have to see what comes out of the 4-year review, but I would emphasize that really the underlying concerns we have not yet been addressed, and we need to work on that going forward.
Janet Yellen spoke to Bloomberg exclusively at the G20 in India. Let's get to Manaka Doshi. She joins me now. Manaka, what did we hear about the U.S.-China relations? This language of creating a floor. What does that mean?
Well, Manus, you're asking me to interpret what the best of economists and political experts will not be able to succeed at. Though reading between the lines is exactly what we've been trying to do here at the G20 meeting in Gujarat in India. You've been discussing U.S.-China trade relationships, and that has been, you know, one of the many talking points, if I may add, here at the G20, the impact of the U.S.-China relationship on trade and globalization. And I must also add here that China is a critical participant in the debt resolution for several low-income countries, and that is one of the key priorities in the discussions here at G20. So all of this is in the mix.
And if I said to you, well, what materialized at the meetings, how would you define that then?
Well, it's difficult to tell because we're a couple of hours away yet from knowing whether we will have a communique at the end of this meeting. You might recall that in the last 2 meetings that have taken place in India, we've ended with a summary of chairpersons and not a communique because of disagreement amongst the partners, specifically China, on the terminology to be used for the Ukraine war. The use of the word war was not appreciated. But that standoff aside, because one can't really quite predict, this meeting has also been a meeting about where there has been discussion on the progress in terms of reforms of multilateral development banks. For instance, the World Bank. Earlier today, I spoke with Ajay Banga, the president, who spoke of how the bank is working to expand its financing capacity. And two of the new instruments that they're hoping to put to use quickly enough is hybrid capital and enhance the power of guarantees. Listen in.
They're willing to take risks in the system. But to be able to get capital out front, they have to go through legislative processes. Yeah. And the reality of the world today, I mean, debt issues and economic issues, they affect everybody. The world's just recovering from the pandemic. Fiscal headroom in the world, even in the developed world, is constricted. Absolutely. So this is a way to find a route around.
That's Ajay Banga talking about how difficult it is for shareholder countries like the US, France, Germany to put more money on the table for development programs and climate financing, and therefore institutions like the World Bank having to get innovative about where they raise their money from. Critical issues that have been discussed here through the course of the last 2 days, and we'll hope to have a final summary by the end of this evening as this meeting concludes.
Okay, Manaka, thank you so much for being with us. Manaka Doshi there at the G20. Still to come, there will be more from the G20. We'll be speaking to Kristalina Georgieva, the IMF Managing Director, a little bit later in programming right here on Bloomberg TV. Coming up on the show today, the European Union and Latin America and the Caribbean Summit continues in Brussels. We'll take a look at the key points and the very latest on the Ukraine-Russia grain deal right here on Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Earnings season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery. Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The European Union, Caribbean and Latin American leaders are gathering in Brussels for the final day of the EU-CELAC summit. It's the first since 2015, reopening talks concerning the long-delayed EU-Mercosur trade deal on the agenda, and tensions have emerged over the condemnation of Russia's war in Ukraine. So there's a lot to unpack. Maria, today I was on the ground in Brussels as ever. It's the first time they've haggled and huddled since 2015. So what I'm curious about is the scale of influence of China in Latin America. This is what has America really on tenterhooks, isn't it? Maria, good day.
Yeah. Yes, Manus, and good morning to you too. And a lot of this today, of course, the European Union would not frame it in those terms bluntly, but it has to do with countering that diplomatic push that we've seen from China through investment in Latin America. And yesterday, the head of the Commission repeated this is a region that is strategic for the European Union when it comes to the economics, when it comes to trade, when it comes to on climate change. And the summit, as you say, is on day 2, but we already had an announcement from the European side that they will invest 45 billion euros from now until 2027 in Latin America. The other big issue here has to do with trade, and you alluded to this as a Mercosur deal. This has been in the making for 20 years, so it's a long time. It's been stuck on a number of issues too for the past, well, 5 years. But yesterday, overnight, a statement from the Euro side, but also the Latin America, including Brazil and Argentina, repeating we hope to get to a resolution and get this trade deal finally over the line in 2023. So that is the end of this year. I think the summit today will really serve to figure out as to whether or not that is realistic to finally get a sign-off on this deal, which both sides would be equally beneficial to them all.
And tell me this, Maria, you're never far from the Ukraine-Russia debate. What is the sticking point between the two blocs? Because it may well be fundamentally different to the conflab within NATO or that US-Russia axis. So what is that Latin American discourse?
Yes, and Manus, I was fascinated to watch your conversation at the G20 because the conversation here is very similar. You have the European countries, of course, the United States and a number of Western allies who say they want the strongest possible condemnation of the war. They say there is no doubt that Russia is the aggressor, that Russia is the country that invaded Ukraine and therefore has to be condemned in those terms. The issue here, and it plays out equally for Latin America, is that there are a number of countries that say they do not have strong opinions of this. They view this as a war that is far away, but also you have key players like Brazil that will condemn the invasion at the United Nations and that will vote to reject motions that would support any kind of invasion and obviously condemn the Russian position in the invasion. But politically, they do not want to go beyond that. They want to stay neutral, and neutral means neutral. So there is also a chance and a risk here that we may end up the day at the summit between the European Union and Latin American countries without a joint condemnation of the war. So this is a very similar conversation as to what is going on with the G20, but also reflects those big divisions that play out internationally now.
Okay, Maria, thank you very much. Maria Tadeo there in Brussels. Good to see you. To the US, the bank regulators there are set to release their plans next week for a sweeping overhaul of the capital rules. Bloomberg has learned that the latest draft includes a tougher set of requirements on the lenders' residential mortgages than international standards. Bloomberg's Tom Metcalf joins me. I mean, one could say, Tom, that this is maybe a hangover from SVB, which is, you know, strike with a big mallet. But talk me through these developments on the changes from Basel III and why the focus on the residential mortgages?
Yeah, so look, these are long-running changes, but as you say, SVB kind of came in the middle of them, and in some ways the sense is that maybe the regulators are becoming a bit more conservative. That's obviously going to shake some level of confidence. And the really interesting thing about this report is for the first time we get in the sense that actually they're going to really focus on residential mortgages, which is news that's going to come as news to the banks. And, you know, you've got to think that the regulators thinking is, yes, perhaps looking at the SVB stuff, looking at kind of the strength of consumer, they just want to be sort of absolutely watertight that, you know, any disruption to the housing market wouldn't sort of feed back into the financial system.
Yeah, well, we're going to hear a little bit more from Morgan Stanley and Bank of America today, and I think it's probably those kind of institutions, along with Wells Fargo, that are going to be perhaps most punched by these mortgage requirements. How do you think the banks are going to react?
Yeah, look, I don't think they're going to be particularly happy. You know, you wonder if they did get any kind of heads up on these discussions. You imagine they do, but you suspect, yes, those banks, the Citis, the Bank of Americas, the Wells Fargos, these are huge parts of their mortgage book, as it is for JP Morgan. And anything like this, these increased capital requirements, ultimately comes and hits the bottom line, right? So, you think, these are still in discussion mode, I suppose. You think they're going to be pushing back. But of course, we're expecting these changes to come through at the end of the month. So not quite sure how much sort of negotiating wiggle room they really have left.
Yep, well, certainly come out of kind of slightly out of left field, Tom, because we're debating where the top of net interest income is, and of course the deposit flight into money market funds. Just a few of the challenges for the banks. We get a little bit more colour as the day goes on. Tom, good to see you. That's Tom Metcalf in London HQ. Now we've just caught up with Klaus Nod, and he made it very, very clear. The ECB. Hikes beyond July are possible, but they are not certain. The ramifications were pervasive across the curve. This is Bund, Bobble, and Schatz, which is 2s, 5s, and 10s. Yields are dropping because he opens up the optionality that the ECB may be nearer to the end of the hiking cycle. More hikes shift the balance of risks, and this is the critically important part. It shifts the balance of risks towards doing too much. So, again, the Fed towards the end or nearing the end of its hiking cycle. Klaus Nod, again, raising the curtain of terminal rate perhaps being reappraised, really gives a second wind to this monster bond rally that you've had across the world, from treasuries to bonds in Europe. This is the second week where this momentum continues. So drawing uncertainty to further hikes beyond July. We'll keep an eye on that. We'll put that to Janet Henry. She's joining me very shortly in terms of her perspective of have we climbed the top of the IGA when it comes to inflation in Europe, and how sticky will that be? Coming up on the show, we have a rare interview with the CEO of Ralph Lauren on raising prices across their product range and what are their plans for Asia expansion, right here on Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make this decision.
Welcome back. U.S. clothing brand Ralph Lauren says it's focusing on China and India as a key growth center outside its home country. The CEO, Patrice Louvet, spoke to Bloomberg exclusively on the potential for the Asian markets and how the company is approaching them.
We want to stay unique and special. That's what we're building in markets like China, and even as we look ahead to markets like India, which are promising for the future, being very deliberate on planting the right foundation so we can build from there with the right image perception.
So China has a huge potential, but it's actually still quite a small market for you.
It is still small for us. Yeah, huge short, mid, and long-term potential for us. So it's about 6% of the company today. That's double what it was 3-4 years ago, but still in absolute quite small when you look at the penetration of the Chinese business for some of the best luxury players in the industry that are 20, 30, 40%. So I'm excited about the opportunities and the runway. What's really energizing for us in China is how the brand is connecting with that younger consumer and that more elevated consumer. I mean, we sell, oddly enough, but I think it's a result of all the elevation work the teams have done, our most elevated products we sell best in China. We have the best gender balance, as I believe you know, most of our business historically has been more men.
Yeah.
In China, it's a good balance, men, women. And it's a relatively young consumer, late 20s, early 30s. So it's actually a good example for us for the rest of the world. We're being very deliberate in our approach in China. So we could grow faster, but we want to do it in a quality way. So we're building the brand. So that serves us well 5 years from now, 10 years from now. But I'm very excited about just more generally Asia and China.
The Ralph Lauren CEO there, Patrice Louvet, speaking to Bloomberg's Francine Lacroix. And at the same time, just look at the product range. They've managed to raise their prices by 80% since 2018. And if you take your mind back 20 years ago, it was a Ralph Lauren pink shirt and chinos that took you to dress down Friday. Nip into Bond Street and you'll note a distinctive change. Coming up, the ECB's top official on the sidelines of the G20 in India talks about inflation.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
earnings countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The global bond rally endures as the ECB Governing Council member Klaus Knott tells Bloomberg the central bank will need to hike again in July. Treasury Secretary Janet Yellen exclusively tells Bloomberg that China's economic slowdown risks causing ripple effects across the globe, but she doesn't expect a US recession. Plus, the G20 finance ministers and central bank governors conclude a two-day gathering in India with participants haggling over debt relief for developing nations. Good morning. Welcome to The Pulse. I'm Manus Cranny in Dubai. So we've had the ECB Governing Council member, Joachim Nagel, saying that the central bank must raise interest rates again this month. The Bundesbank chief spoke to us exclusively on the sidelines of the G20 finance chiefs meeting in India, warning that underlying inflation is proving very sticky.
We have to hike next time, and I expect another 25 basis points hike for the July meeting. And then we agreed in the Governing Council that we wait for the data that is coming in. So we have that short summer break, and then for the September meeting we will see what the data will tell us.
Meanwhile, the Bank of Italy Governor Ignazio Visco gave some indication that the path ahead for energy prices is the key contributor to the inflation narrative in Europe.
When they end being passed through and they start reflecting the fall in energy prices, then we will certainly see a substantial reduction. This is in our projections. We project that by the end, the ECB projects that by the end of 2025 there will be 2%. My impression is that it might be faster.
And then it was the turn of the Dutch central bank governor, Klaus Knott, with his couple of lines really saying, looks like core inflation has plateaued. And any hikes beyond July are not certain. More hikes could shift the balance of risks towards doing too much. Don't want another policy error? Let's get to HSBC's global chief economist, Janet Henry. Janet, has European, and I'm being very specific, European inflation peaked? And it's interesting that Knott warns that the balance of risks is doing too much rather than too little. So 2 for 1, better than Tesco's on this show. Good morning.
Good morning. I think inflation has peaked. It's peaked nearly everywhere. In fact, global inflation peaked last September. But for central banks, in some ways, the move from 10-ish to 4 or 5 was the easy bits. 4 or 5 to 2, as we've discussed before, is where the real challenge lies. And, you know, your question is about Europe. European inflation will fall. And it was interesting hearing Visco's comments regarding energy. You know, we just had that very low print from the US last week, 3% inflation for June. But that is likely to be the low from now. The base effects from this time last year were the highest. And actually, it's still about what is likely to keep inflation persistent for longer and how far away are they still going to be from their targets. From other factors, it's not just about the energy story. We've had the easy bit from that already.
Okay, so if the easy lifting has been done, you're right, this last mile of delivery is going to be hard. By the way, you know, OPEC won't last until that oil is briskly above $80 a barrel. So, you know, be careful on that. It would be the caveat. I then look at China and I look at the deflator. So you look at the downgrades to growth. We'll come back to that in a moment. But the deflator within China is negative for the first time since 2009. We're going to show a chart on that. Again, the issue here is how prescient is that for a global deflation? These are the growth targets that we're showing, but we're going to show you the deflator for China in just a moment, the most negative since 2009. How destructive or constructive is that for the global deflation narrative?
we are seeing, certainly not deflation globally, but we are seeing the beginnings of some element of disinflation. And we've got to remember, in terms of China, households and more generalized inflation didn't feel the pressure from energy. You saw it at the PPI level. Big companies had to pay those big energy prices. Households in particular were insulated to some degree. But also when we think about how China feeds through to the global economy, through commodity prices, it does feed through on the demand side. And as much as China demand has disappointed, it has still been growing. You look at coal or oil, and even copper, so far this year, in volume terms, it's risen, but global prices have been weaker, so nominal imports have been a little bit softer. So yes, weaker demand, weaker pricing power coming from China will impact, help to some extent the inflation story elsewhere in the world. But in the past, where we normally saw it was in goods, and actually goods price inflation is very low and falling in some countries, where we see the current pressure on inflation in the West is obviously still services and in wages.
You still see quite sticky global inflation, just under 5%. What does that do to central bank policy? We can circle in on G3 or G7, wherever you want to hone it in, but that's still quite a sticky number at 4.8%, isn't it?
At the global level, it's still something that is not consistent with central bank targets, but of course that does include the emerging economies as well as the advanced economies. So we have inflation moving in the right direction, just still above central bank targets. But when we're focusing on the advanced economies in Europe and the US, it's very clear it's not just about the monetary policy, it is about what's happening on the fiscal. And what we've seen, particularly in Europe in 2020, in 2021, in 2022, and in 2023, it's been the government spending that's been adding to demand. And over the last couple of years, central banks have been trying to slow demand by raising interest rates. So as the ECB has been quite clear, the fiscal stance of governments is not appropriate for the overall inflation picture. The Fed's been a bit less explicit, saying it's their job to respond to the fiscal side as much as rather than to tell the government what to do, in the same way that they expect the government not to tell the central bank what to do. But you need to view the two together when you're thinking about policy and how it works.
How much fiscal do you think fiscal cuts are going to be a feature over the next 18 months? I just look at the state of Europe at the moment, look at what France has just gone through, look at the as it were, the heat issue that they've got at the moment. There's a lot of unrest in Europe. Is there room for fiscal cuts, Janet?
Well, there is obviously a plan to reinstate the fiscal rules in Europe in 2024, but events happen. So a lot will depend on exactly what is happening to global energy prices, and not just oil, what happens to gas prices and other utility prices. And also, when we think about the fiscal side, it's not just about whether they cut spending or they cut subsidies. Energy subsidies are obviously a big part of where the fiscal support has lain over the course of the last year or so. But it's also interesting when you look at it in a US context. It's really now about the tax subsidies. The US is in the midst of a manufacturing boom for construction at the moment. That's adding to jobs for construction, that's adding to demand in that sector, but it is through those tax incentives. Now, 5 years from now, that might be good news from the supply side and productivity, and good from an inflation side of things, but at the moment, it is the demand side where the support is coming from. So I think there's going to be a lot more talk about fiscal in the next year or so. In many ways, their job is just getting harder at a time when obviously we're hoping that central banks are in the final innings regarding tightening monetary policy.
We're just coming off the G20 and they're haggling over debt relief for emerging markets, developing nations. But within that construct, of course, the whole world is looking towards India as the sort of sanctuary for their growth. Apple is doing it at a corporate level. Other people are as well. How much growth will we see as we call into question the trajectory of China's growth? The downgrades coming through this morning to 5%. How strong will India and other parts of Latin America be?
Well, it's interesting. In our latest round of forecasts, it won't surprise you to know that we downgraded China and we did actually upgrade India and Latin America. Now, obviously, the kind of growth rates that you can expect out of Latin America are only a fraction of those that we're forecasting for India, but growth in Latin America, it has been more resilient than we'd anticipated in the face of what are really high real interest rates. And obviously, there's certain elements of the Latin American story, not least in energy transition, given the overall metal story that structurally should be quite supportive for parts of Latin America. But India, yes, it is of the significant economies, it is the one where we have got the strongest growth rates. It has some stronger fundamentals regarding demographics, obviously, and finally, investment seems to be building. So as long as they can continue the development in terms of skills and education and support that through higher investment spending, then in the near term, India still has a lot of catching up to do to get to China levels of GDP per head. But for the next decade, like many, we are looking for stronger growth from India.
Janet, thank you very much. Janet Henry there, HSBC's Global Chief Economist, with the first take on the ECB commentary from the G20. Coming up on the show, it is earnings season. It continues aplenty on Wall Street. The regulators are proposing sweeping changes to the capital requirements. Where will it bite? Joost Beaumont, head of bank research at ABN AMRO, joins me for a conversation on the street earnings, right here on Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Welcome back. U.S. regulators are set to release their plans next week. It's going to be a sweeping overhaul of the capital rules. Now, it comes ahead of Bank of America and Morgan Stanley reporting their numbers later today. Joost Beaumont is the head of bank research at ABN AMRO. Joost, we're showing our viewers the perceived impact of this capital increase on the mortgage books for some of the big players in the United States of America. This is quite a brutal new rule. It's for banks with more than $100 billion in assets. So it's going to be quite a smack to the regional banks. Your first take on the headline that we have stiffer mortgage capital rules. The impact. Good morning.
Yeah, good morning, and thanks for having me on the show. But of course, this will lead to this will have quite a big impact. It will hit, of course, earnings of banks, as capital is expensive. So banks will need to pay more for that. That can also filter through in their lending conditions. It can also, of course, change their lending behavior if they want to reduce their risk-weighted assets, for instance, to also improve their capital ratios. That can mean that banks will become more cautious in lending. So the total impact, on the one hand, you have the economy, so it could hit lending to the real economy. On the other hand, you have the bank earnings, which might be hit as well. But it was something to be expected, maybe not this harsh after the failure of the US regional banks. And it's another step of regulators to make the banking system more sound, although you can also wonder the current capital ratios are actually already quite at high levels compared to definitely the global.
You just wonder, you just wonder to what extent this is an additional inflection after SVB and First Republic and I suppose the turmoil that we had at the start of the year. I wonder what it does. What goes through my mind then is US banks relative to European banks. Does it create a bifurcation in your mind as the market assesses, do I want to be long JP Morgan? Do I want to be long B of A? Do I want to be long Wells Fargo? Relative to my Soc Gen BNP Paribas, does this, as it were, bifurcate? If this is more penal for US banks relative to the global standard, how might that play out?
Well, if you look at the average CET1 ratio, for instance, of European banks, it's already well above 15%. Of course, not all banks. So in that respect, it's maybe also a bit of catching up of US banks with European banks. In the end, I think it might hit the US regional banks more harder than the big banks. But in any case, what it will tell investors is that banks will become even safer. So you can think of investors preferring these safer, bigger banks over the smaller banks with lower capital ratios.
The big just get bigger, and that takes us to the Goliath of them all. I know that you can't talk about individual names, but I love what Wells Fargo, Mike Mayo had to say about JP Morgan. Their structural position is that they are strong as it's ever been, allowing them to show greater share, scalability, and resilience. And JP Morgan stands the tallest. It is a Goliath, really, really winning. And, you know, with that in mind, when you look at some of the bulwarks of Wall Street, JPM, we'll get a little bit more, as I say, from Morgan Stanley and Bank of America later today. Goldman's will have warned us so much in advance. But when you look at that strength of positioning on JPM, what does that do? Because the banks index is up, what, JP Morgan's up 14% on the year. Do the big just get much, much bigger now? The UBS, the JPM, are we just going to see a much bigger musculature in size?
I think indeed it's a good observation. After all the turmoil we had, the bigger banks become bigger and absorbing the smaller banks that fail. Of course, that looks good in the short term because it solves some issues, but in the longer term, you might go back to the too big to fail discussions with the big banks becoming really, really big and indeed too big to fail, which can create issues, of course, later on when we have a new banking crisis. So it solves issues now, might be an issue later on. That's maybe also why regulators want to increase capital ratios, to be sure that banks are also in the future well equipped to absorb any shocks.
Well, one Goliath that is, you know, created overnight, well, actually over 48 hours, is UBS. Now, the buyback and the dividend, you know, the buyback has been delayed, and we're going to learn more and more at the end of August about what is UBS, what will they get from the state, what will they give back. But in terms of the thesis for Europe, does it sit the equivalent Is Armoti basically going to create the JP Morgan? I mean, it already is within wealth management, but does it just accelerate now to a new valuation for the market?
Yeah, of course, with UBS, yeah, you have put together the two biggest banks in Switzerland and also quite big global players. So definitely, this is a new cookie in the market, and indeed, we need to see with UBS how they will.
What's the risk with UBS? What's the single biggest thing I should keep an eye on for the 28th? I think it's the 28th of August. What's the biggest risk as you look at that landscape for UBS? Is it the backstop from the government, maybe sized down? What is the risk?
I think the risk might be more into still the investment bank from Credit Suisse. They have to merge this. They have to align it with the risk profile of UBS. There's of course a huge misalignment here. So there are risks that this wind down of the investment bank might come with some losses, maybe higher than expected. So I think that is something definitely to watch.
Okay, well, certainly the staff have a very real issue on their hands on tenterhooks to hear what size that investment bank, the new investment bank, will be. Of course, there is a culture test to pass, according to the chairman. Joost Bouwman, thank you very much, head of bank research over at ABN AMRO. And don't miss our interview with the Morgan Stanley chairman and the CEO. James Gorman joins the Bloomberg team, 6:30 p.m. London time. Coming up, the UK's richest person is chasing one of the biggest trophy assets probably in the world. Manchester United. We discuss the challenges facing this man right here on Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to The Pulse. Jim Ratcliffe, there's a name that you're familiar with. He's chasing one of the biggest trophy assets in the world, Manchester United. The trouble is that the self-made billionaire from the north of England is competing against a royal from the Gulf. Right down here, $450 billion sovereign wealth fund chasing the same prize. Ben Stupples is with me. Ben, I think we're looking at Manchester United now up over 100% in the space of a year. Why does he want to get his hands on this? Is it the northern lad turned into billionaire who just wants the prize asset that everybody wants, 114% on the year? Is it vanity, or is it something much more judicious?
I think it's a little bit of both there, Manus. As you say, Jim Ratcliffe is the northern lad. He has positioned himself as the local lad, the local billionaire who grew up in the Manchester area for the start of his life, buying this storied club of Manchester United. However, there is business behind this. Jim Ratcliffe has said he's not bothered about making money here. However, this deal would elevate his sports portfolio, which already spans several other sports, cycling, Formula One, for example, and some other football teams already. But this would take him to the next level. Let's remember here, he is the richest man in this country, a G7 nation. It feels fitting, if you're Jim Ratcliffe, that I could buy a Premier League club. However, that's not been so easy.
Well, he's got, what's he got, $16.4 billion. That's the disclosed number. There's always a little bit more under the bed, isn't there? He's up against the Qataris. They've got deeper pockets than Ratcliffe, I presume?
Yeah, deeper pockets and some more, I would say, Manus. I mean, to give a sense of the sort of the wealth wars that we are in here, Qatar is one of the world's smallest nations. We're all familiar with that nation from the recent FIFA World Cup, aren't we? I mean, it's one of the world's smallest nations, and the sovereign wealth fund, as you noted, $450 billion. Now, it's hard to say exactly the member of the royal family from Qatar exactly what his wealth is.
Yeah.
However, you know, that gives a sense of the size of the enormous wealth at the sort of disposal. So what we have here is a battle, different types of wealth, self-made wealth versus sovereign wealth.
Indeed, and there's, of course, a great deal of history and passion for one individual, which is Jim himself. Ben, thank you very much. Going up against Sheikh Jassim bin Hamad Al Thani. I spent a lot of sweaty days outside that stadium in Qatar. Bloomberg Surveillance, early edition with Kriti Gupta from New York. And Danny Berger in London is up next.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Wall Street banks brace for tougher rules from U.S. regulators next week that go beyond global standards. Morgan Stanley and Bank of America are set to report results today. Details emerge on the U.S. crackdown on China tech investments. The curbs will be targeted and likely won't go into effect until next year. And Treasury Secretary Janet Yellen says China's economic slowdown risks causing ripple effects across the globe, but she doesn't expect a U.S. recession. Bloomberg is live in India as G20 finance chiefs conclude a two-day meeting. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, Team Soft Landing really seems to be picking up some more players. You have Jan Hatzius, and the Bank of America survey just had a majority of investors say they think a soft landing is coming.
Yeah, that Goldman call, I think, really changing a little bit of the market perspective, giving some weight to the folks who are saying maybe we can just navigate this all right. And I think bank earnings have a lot to do with it. The messages we got last Friday out of JP Morgan and the other banks really helped with that narrative, saying, look, consumers are doing just fine. Take a look at the credit card numbers. Take a look at loan loss provisions. The numbers are coming out just great. The question is, does that stand in today's bank earnings story as well? We've got Morgan Stanley coming out among a slew of others as well. Take a look at futures, though. It feels like that's really where we're waiting for what those bank results are going to tell us, to perhaps give that Jan Hatzius, a Goldman call, a little more momentum when it comes to the soft landing. What gets interesting to me, Danny, though, is that the bond market might just be on a different page. 469 on the front end of the curve, already seeing a pullback, again, at 5 a.m. New York time of about 5 basis points. That is a big deal when you're talking about the moves in pre-market trading. It also makes sense as we talk about a repricing. Remember, in addition to that soft landing narrative, more and more folks are coming out of the woodwork and saying maybe those cut expectations, maybe they're not going to come immediately in 2023, but they might just come in 2024. And that's an interesting kind of realm where you are seeing a little bit of momentum, if you will. As we look at the yield story, we have to look at the FX story as well. The dollar actually weaker against a slew of currencies, but the Korean won seeing the biggest move against the dollar. You are seeing the dollar weaker about 0.5% against that currency. What's interesting to me, though, is that overnight you also saw the Samsung, the Kospi index that has Samsung is about 33% of its weighting, also sell off in a really big way. It tells you chips are part of the narrative, at least when it comes to the overnight trade. We're going to connect the dots for you later on in the show. And of course, always a check on the commodity space. NYMEX crude trading at a 74 handle, Danny.
Pretty, let me give you a check on Europe, because European equities are gaining this morning after an ugly day yesterday, really spurred by China. So we haven't made up for those losses, but we're on our way to do so. The overall index up about 0.2%. Leading the way is Ocado, the online grocer, turning their Marks & Spencer's JV profitable. So that got investors excited they'd be able to keep costs in. But really, I think the interesting thing on here is the CEO, and speaking to reporters, saying that UK food inflation is on its way down. It has peaked. There's some macro data to back that up too. That was out early this morning. The other big European mover is what we got out of the G20 meeting. Bloomberg was speaking with Klaus Knot, who had a more optimistic view of inflation's ability to come back in. It's similarly what Viscos from the Bank of Italy said too. So those more confident voices about inflation has spurred a really big rally. Schatz leading the way here. 2-year yields down nearly 10 basis points. And the strength we saw in the euro is pairing because of that. It is still, though, stronger versus the dollar. That is its 9th day of strengthening versus the greenback, which is its longest winning streak, should it hold, since 2004.
Yeah, it's interesting. This interest rate differential is kicking in as we talk about what the central banks are repricing. But that's just one part of the story, Danny. We go from central banks to Wall Street banks as well. U.S. bank regulators poised to release plans for a sweeping overhaul of capital rules next week. Bloomberg reporting the changes would include requirements for large lenders' residential mortgages that would go beyond global standards. For more on this Bloomberg scoop, we're joined by finance editor Tom Metcalf. Tom, walk us through the story. The focus on residential mortgages is very specific.
Yeah, exactly, and that's really what's new today. So, these Basel III regulations have been sort of known about. They're coming into effect effectively. The last couple of years they've been basically in negotiations about them. What's coming through today is actually there's going to be this laser focus on residential mortgages. That's, of course, going to be a particular sort of interest or impact for banks like the Citis, the Wells Fargo. And the reason why is, I guess it's where the regulators see probably the most risk. They're trying to make sure the kind of banking system is insulated against any, downdraft in that market. But of course, for the banks, that's a really big business, and, extra regulatory requirements around that will hit their bottom line.
We're also going to get more bank earnings today. We have some regional banks. There's Morgan Stanley, Bank of America. What are you looking out for, Tom?
Yeah, definitely Bank of America and Morgan Stanley will be fascinating. How does Bank of America do more on that retail banking side? And then for Morgan Stanley, obviously almost now more of a wealth manager, right? So how they do, and that sets us up nicely as well for Goldman earnings tomorrow.
Yeah, certainly. Looking forward to those ones. Tom, thank you very much for setting it up. As always, Bloomberg's Tom Metcalf. And speaking of which, coming up later today, Morgan Stanley CEO James Gorman, following the bank's second quarter earnings report, will be speaking to Bloomberg. That's at 1:30 p.m. New York time, 6:30 p.m. if you are here in London. To the world of tech, the Biden administration's plan to restrict investments in China will be narrowly focused on cutting-edge technology. Only new investments and likely won't go effect until next year. Joining us now on this is Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins. Rebecca, these plans sound pared back from what we had heard earlier.
Yeah, it's interesting. They do. There was some sort of speculation that they might include things like biotech or energy, but actually these really seem to be characterized by being targeted and also by being slow. So the emphasis here is the investment restrictions that would be screened or potentially entirely prohibited, but limited to areas of national security, so artificial intelligence, quantum computing, and semiconductors. So that's somewhat narrower than some were expecting, and certainly that Hawks on the Hill were hoping for. The emphasis also is in quite a slow rollout. It looks like officials are aiming to have a proposal together by the end of August, but we wouldn't see enforcement until early next year, and we'd really only see enforcement going forward, so nothing retroactive, which again may be a little bit of comfort to companies too. It does look like we have been waiting for these plans for quite a long time, and it does look like the Biden administration is really trying to take their time to work this out and avoid any inadvertent consequences, in part because this is something that really hasn't been tried before at this scale, something that could affect tens of billions, potentially even trillions of dollars of investments here.
Speaking of trying to avoid some sort of bigger fallout, it's interesting that the White House and perhaps the corporate side are on two very different pages. U.S. chip makers, for example, meeting at the White House yesterday, perhaps trying to lobby for easier regulation. Walk us through that, Rebecca. How are they kind of approaching this issue?
Yeah, we did have CEOs from across the semiconductor industry, but including NVIDIA, Qualcomm, Intel, making their way to the White House. There was also a sit-down with Jake Sullivan, the National Security Advisor, too, again stressing this emphasis that is not sort of widespread economic policy, but something that's targeted and focused on trying to help U.S. national security. Now, they are obviously deeply concerned, U.S. Tech CEOs, deeply concerned about the impact, essentially, that this idea that if you restrict U.S. chip makers from the access to their largest industry, from their access to China, that will really hurt their revenues. Qualcomm, for example, depends on about 60% of its revenue comes from China. It's worth mentioning, too, that some of the representatives from those same firms were actually in Beijing last week, also speaking with top officials. And Beijing's line on de-risking, decoupling so far has actually been to try and suggest that companies themselves, U.S. and foreign companies themselves, should be the ones to define de-risking, should be the ones to define where they want to diversify and pull back, rather than this being something that governments push for.
Yeah, a lot to dissect. The Rebecca Chung-Wilkins all over it for us. We thank you, as always, for joining the program this morning. Let's turn to the G20 meeting in India, where China, of course, has been the focus. U.S. Treasury Secretary Janet Yellen says Beijing has failed to address the unfair trade practices that led to Washington imposing tariff hikes on the country.
We're undergoing a 4-year required review of tariffs. We have to see what comes out of the 4-year review. But I would emphasize that really the underlying concerns we have not yet been addressed, and we need to work on that going forward.
Janet Yellen there speaking exclusively to Bloomberg Television. For more, we're joined from New Delhi by Menika Doshi at the G20 meeting there. Menika, what have we been hearing about the U.S.-China relations specifically? Walk us through the kind of rhetoric there.
Well, we've had a range of comments come in from U.S. Treasury Secretary Janet Yellen in the week that she's been here in Gujarat, in Gandhinagar, where the G20 meeting of finance ministers and central bank governors is underway and on its last day. And we've heard the Treasury Secretary just moments ago talk about that 4-year review where the U.S. has not seen any change in China's trade practices to consider lifting any of those tariffs. The U.S. is also imposing restrictions on certain outbound investment into China. Treasury Secretary Yellen saying that these are narrowly focused and they're unlikely to impact the Chinese economy or investment in China in any substantive way. And finally, she also did comment on the very tepid recovery in China and the impact that would have on the global economy, saying there would be spillovers, but it's unlikely to prompt a recession in the U.S. The Treasury Secretary there walking a fine balance between making sure that the economic relationship with China continues whilst raising all the issues that the U.S. has had differences on over the past several years.
Menika, there's been just such a wide range of conversations from ECB policymakers who have sounded more dovish. That's been fueling a bond market rally, to EM debt relief, too. What has materialized specifically on that point of emerging market debt relief in the meetings?
Well, you have to know that these are baby steps. These G20 meetings don't necessarily always result in very big, quantum jumps in policy making across the world and therefore big headlines. But it does seem that there has been progress made in the conversations that have taken place here over the last 48 hours in being able to extend in a speedier way debt relief to several low-income countries. Now, many of the G20 members here drawing some strength from the Zambia resolution, which was a default resolution, drawing some strength from that and hoping that now that that's out of the way, other countries can follow suit. In fact, we spoke with the South Africa finance minister who said just this, that he is glad to see more convergence in this meeting than he has seen in previous meetings.
This G20 meeting, unlike last year, we are moving quite closer to each other on a number of topics. Among other things, for instance, the broadly general consensus on fast-tracking the debt relief program in terms of the common framework agreed in the G20.
That's the South Africa finance minister speaking with Bloomberg earlier today. By this evening, we should hopefully have some sort of statement of remarks, a summary in technical language, not a communique, of the outcomes of this G20 meeting. And then all the attention will shift to the Leaders Summit in September. That's where you will probably see more concrete decisions being taken. Here's where all the fine print gets hammered out. With that, it's back to you from Gandhinagar in Gujarat.
Menika, thank you so much. I also love that. A background noise of beautiful birds chirping and maybe even a car alarm in there. Bloomberg's Menika Doshi doing it all, reporting from the G20 meeting in India. All right, coming up on this program, Aberdeen's James Athey is keeping his money in the bond market. It's been a good time to do that, considering the rally we've seen. We're going to catch up with him later this hour. And don't miss our exclusive interview with the European Commissioner for Financial Services. Plus, U.S. bank earnings continue with Bank of America and Morgan Stanley before the bell. We'll have more on that still ahead. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery. Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Well, dovish talk in vogue among central bankers as markets see some signs of a reprieve in inflation. The latest Bank of America fund manager survey shows more and more investors are now betting on a soft landing relative to a hard landing, that coming amid expectations that central banks are nearing the end of the rate hiking cycle around the world. For more, let's bring in Bloomberg's Ksenia Galushko from our equities team. Ksenia, what does this mean in terms of the read-through for the equity market? If we're already seeing green on the screen before even this kind of soft landing was really expected, does this just accelerate the momentum into equities?
Well, it depends on how you position, right? Most investors are already quite into this rally this year, so this could signal some caution for the second half of the year, actually. But what is interesting from the Bank of America Fund Manager Survey is that investors are getting slightly more optimistic on corporate profit growth and on the soft landing. At the same time, they're not expecting the first Fed rate cut until the second quarter of next year. So they actually pushed back the expectations from the first quarter of next year to the second quarter. So while they are expecting the soft landing and no recession, at the same time, the sentiment remains quite cautious. And investors overall in this major global fund manager survey, which mainly focuses on major big investors globally, it does show that investors continue to be underweight equities, although this is the smallest underweight this year. So they are reducing their underweight slightly.
What about crowded positioning? I know the survey typically asks about that too.
Yes, so crowded positions are quite interesting. So the biggest of them all is the US big tech stocks. And there's really no surprise there because honestly, the biggest rally that we've seen in equities so far this year has been in the NASDAQ and US big tech stocks. This is creating some risks for positioning because if anything goes wrong for big tech stocks, especially as we approach this earnings season, if there's any disappointment in AI expectations from the likes of NVIDIA that have powered this rally, we might see a sharp drawdown, especially in the NASDAQ, and especially since these big tech stocks have such a major weighting in the S&P 500. This could be quite risky for this rally that we've seen this year.
All right, Ksenia, thank you very much. That is Bloomberg's Ksenia Galushko. I want to bring us some breaking lines now on Deutsche Bank. Deutsche Bank is drawing some ECB scrutiny over their FX swap sales. They've been told to improve their oversight and checks. Now, these instructions from the ECB follow months of internal FX derivatives probes from Deutsche Bank. So the supervisory team saying, improve your oversight, improve your checks when it comes to FX derivatives sales. Shares dropping now about 0.4%. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now to some UK stories that caught our eye this morning. And grocery prices in this country, inflation to be specific, has dropped at its fastest pace since the peak in March. Price growth slowed 1.6 percent points in the 4 weeks ending on July 9th after falling for 4 consecutive months, according to Cantor. Kriti, this news comes ahead of UK CPI tomorrow. So maybe some positivity, maybe some hopefulness that those prices will finally come in overall.
Yeah, and of course we know that food, there isn't a ton of elasticity when it comes to kind of the economic spending that the average British consumer might have. But Danny, I have to say, when you look at this from a global perspective, perhaps, I've heard anecdotally that food and groceries are actually cheaper in the UK and Europe than in around the world. As an expat, your take on that?
It's true. It's absolutely true. But they are rising a fair amount. But whenever I go back to New York, I definitely get a sticker price shock, and I forget how expensive things can really be. Not to mention, Kriti, we broke the news yesterday of Russia pulling out of that grain pack. I mean, the reason food inflation was so bad in the UK was because of Ukrainian grain not being able to get to the rest of the world. So this could be another reason food inflation picks up yet again.
Yeah, and I think what's interesting here is that when you talk about food inflation, it's not just about the Ukrainian story, because of course it is a major factor, but then you have the idea of, say, rice protectionism emerging in likes of India and Southeast Asia. You have the idea of drought and weather conditions hurting the U.S. grain exports, which of course is also a major contributor to agricultural prices, not to mention things like cattle and livestock, for example. So there's a lot to digest when it comes to the world's food space. And I think even though we're talking about inflation increasing in the US and the UK, or decreasing now, when it comes to the food prices, take a look at some of the emerging markets where food prices are still climbing. And that, of course, is something that you can't really skimp on.
Yeah, and the weather is just atrocious. There's El Nino, there's heat waves going to make all of it worse. I think I saw a story, something like tomato farmers in India were getting record prices. So at least for now, a good time to be a tomato farmer, apparently. Kriti, another UK story that caught our eye. The number of Britons who would vote to remain in the EU if the Brexit referendum were to be held again is at its highest level, according to a YouGov survey. 51% of respondents said they would vote to rejoin the bloc, while 32% would stay out. You know the best thing from this survey, though, you pointed this out too. It's the entry of the Brexit lexicon, regret. Those who regret Brexit, 57%.
Yeah, but let's talk about these numbers really quickly before I crack up at the title of this chart. The idea that, I mean, it looks from just simply the chart is that this is increasing, but if you look at kind of the way these pollings have come out, it doesn't show that much of a change when it comes to kind of the everyday talk and the everyday sentiment around Brexit. I wonder if there will ever be another opportunity to rejoin the EU in the future, but for now, I guess we'll have to do with this.
Yeah, I mean, considering the elections we have coming up, look, likelihood, talking to those politicos who watch this stuff, something like 10 years if we do get another vote to rejoin. So yes, the sentiment might be changing, but the action will likely take some time to come. All right, coming up on this show, we're going to get back to the market story. We'll speak with Aberdeen's James Athey as European bonds rally off the back of an interview with Klaus Knot. This is Bloomberg.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Wall Street banks brace for tougher rules from U.S. regulators next week that go beyond global standards. Morgan Stanley and Bank of America are set to report results today, amid others. Details emerge on the U.S. crackdown on China tech investments. The curbs will be targeted and likely won't go into effect until next year. Meanwhile, Treasury Secretary Janet Yellen says China's economic slowdown risks causing ripple effects across the globe, but she doesn't expect a U.S. recession. Bloomberg is live in India as G20 finance chiefs conclude a two-day meeting. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest here, but the calls for a soft landing around the world, not just in the U.S., really picking up steam.
Yeah, we heard from some ECB chiefs, which we'll get to in just a moment, talking about hopefulness over inflation coming down. And that has had an impact on the bond market. We're getting a bit in the front end of the German curve. All about chats this morning. Those yields down by about 0.9%. Euro, some of the strength there coming in because of that, Kriti, because of the buying we're seeing in the bond market, though it is still stronger for its 9th straight session, which would be the longest since 2004. Meanwhile, in equity land here in Europe, we're up by about 0.25%. It was a really ugly day yesterday. Luxury goods absolutely hammered over concern about China, and Richemont sales, which showed a weaker American consumer. But over here, a lot about grocery prices. We're just talking about this, Kriti. Ocado had really solid earnings. They're the online grocer. They also sell a platform for automated grocery when it comes to warehouses. One of their joint ventures with M&S finally profitable, but their CEO adding fuel to this disinflation fire, at least for food in the UK, saying that UK food prices have peaked and they're coming down, Kriti.
I mean, we just went into a whole thing about UK food prices, but I gotta say,
yeah, we don't need to do it again.
Yeah, I'll just say, sitting in New York City, not a fan of food prices. What I will say is that the inflation story still is top of mind for equity. The equity futures, not so much though. You are seeing them unchanged. A lot of that kind of caution ahead of those bank earnings. Remember, they're just as important as perhaps monetary policy in terms of what we're seeing from the U.S. consumer: credit card spending, loan loss provisions, even trading volume. Talking about the bond volatility, and we should go right there because you're already seeing that bond volatility take over in the pre-market session. Two-year yield here already down by about 5 basis points. It really tells you that concept of a soft landing. The commentary from the likes of Jan Hatzius over at Goldman Sachs really moving the market this morning. 469 on the front end of the curve. You go further out to the 10-year, you are seeing the same thing, 4 or 5 basis point moves. You would think that as the yields come down, the dollar would come down with it. And it kind of has against some of the major currencies. Danny, you just walked us through some of the currency picture throughout the show. But overnight, the biggest contributor to the Bloomberg Dollar Index was actually the Korean won. You saw a major sell-off in those chip stocks, which affected the index, which also then affected the currency. Nevertheless, it's actually weighing on the dollar to the tune about 0.5%. As we talk about inflation, though, we have to talk about recession odds. And for that, we get our commodity check. 74 handle, Danny, on NYMEX crude.
Still can't seem to break $80. Kriti, to that ECB story, I teased it, so we got to talk about it. ECB Governing Council member Ignacio Viscos says that inflation may come down more quickly than forecast. Viscos spoke to Bloomberg earlier at the G20 meeting in India.
When they end being passed through and they start reflecting the fall in energy prices, then we will certainly see a substantial reduction. This is in our projections. We project that by the end, the ECB projects that by the end of 2025 there will be 2%. My impression is that it might be faster.
Meanwhile, another ECB Governing Council member, Klaus Knot, told Bloomberg that monetary tightening beyond next week's meeting is anything but guaranteed, suggesting officials could soon pause their unprecedented campaign of interest rate hikes, adding that it was likely we'd get back to 2% by 2024. Let's bring this all now to James Athey, Investment Director at Aberdeen. James, the net effect of this has just been adding fuel to this global bond market rally that we've been seeing over the past week. Is this more than the U.S. optimism inflation has come in? Do you share that same optimism for European inflation?
Hi, yeah, morning, Danny. Essentially, yes. I think, there is a narrative out there that we're seeing a disinflationary trend as a result of the monetary tightening that we've seen from most central banks over the last year. I think the reality is that most of the disinflation that we're seeing is really just the other side of the pandemic and lockdown-induced supply shocks, which kind of buffeted the global economy over the prior few years. In that respect, it's the other side of the sort of transitory inflation narrative. That's not to say that central banks were wrong to hike rates. I think by hiking as aggressively as they have prevented a sort of counterfactual embedding of inflation. They have prevented a greater degree of second round effects. But largely what we're seeing is just that there was an increase in the price level. And once we got to that new higher level of prices, of course, the rate of change then tends back towards zero.
The FT has a great piece out today talking about this idea of this being a Potemkin disinflation narrative. In other words, it's just this facade. It kind of feels like what you're describing to some degree here, James. So if again, it's just based on base effects, how do you want to position in this bond market? Is this rally then gone too far?
Then it gets into timing. When we're talking about a 30 basis point or so rally, when the sort of 2 months previously we'd sold off anywhere between 70 and 150 basis points. Looking at the UK, we're still absolutely miles higher in yield terms than we were just a few months ago. In that respect, it's difficult to argue that this little ralliette, as we would call it, has gone too far. But of course, the data that we are seeing in front of us today, particularly in the US, I have to say, the European data has definitely been softer, but the US data is showing disinflation without the more scary kind of weakening of growth dynamics. And that's where this soft landing narrative comes from. So how long we can stay in this holding pattern probably dictates the extent to which you want to be long duration, whether you want to be actually opposing some of the cuts in 2024, whether you want to be in steepness or flatness. The timing is always difficult. We would always believe that about these events, these triggers, these inflections only in the rearview mirror. They're very difficult to forecast precisely. We would look at the balance of risks, the balance of probabilities, and say that we expect the disinflation to continue. We expect it to move significantly from headline into the core measures. We're seeing some evidence of that, but we also expect the economy to continue to slow. That informs our positive view on government bonds. That's why we like duration. That's why we've been adding duration. And we do think that the curve will trend steeper at some stage.
And James, I think that's a view, at least from an economic perspective, that's shared over at Goldman Sachs. I want to bring our audience the call overnight from Jan Hatzius, is the chief economist. They're cutting U.S. recession probability in the next 12 months from 25% to 20%. The team writes, there are strong fundamental reasons to expect ongoing disinflation. The recent data have reinforced our confidence that bringing inflation down to an acceptable level will not require a recession. James, I want to come back to you because the definition of recession also includes, to some extent, a wave of layoffs, an increase in unemployment. We haven't yet seen that and therefore have understood that maybe we might not even get there this time, therefore encouraging a soft landing. But how quickly could that change given the labor environment that we're seeing? Strikes across the United States, strikes across Europe, and really this idea of wages not going up in line with the movement you're seeing in the rest of the economy. How do you think about that, James?
Yeah, I mean, absolutely. I would agree that the recession has to be characterized by an increase in unemployment. You know, if you look over multiple cycles over decades and decades and decades, really the economic cycle is described by changes in unemployment. I think where I have a problem really with the soft landing narrative is that it essentially implies finding an equilibrium at a steady rate of unemployment at these lows. And history says that that's actually very difficult to achieve. It would be interesting to try and understand whether the soft landing narrative requires the Fed to ease policy back towards neutral in order to maintain, or if indeed R-star is much higher and rates can be maintained at this higher level. That's two very different worlds from a bond market perspective. But my expectation is that we still haven't seen the full effect from much of the Fed's tightening from probably the second half of last year, at least onwards. And as that increasingly acts as a headwind, along with running out of accumulated savings, along with a precautionary increase in the savings rate, which there was some evidence of in May, as we see these dynamics play out, I do believe that we will begin to see, jobs growth continue to moderate, but ultimately flip to negative, and we'll see an increase in unemployment. Economies, display inertia. And so once we start moving in that direction, it does indeed feed off itself until there's a countervailing force. Normally that countervailing force would be a central bank easing policy. So ultimately that would still be my expectation. But I think actually the yield curve can disinvert even if I'm wrong and we find a sort of stable equilibrium at a higher level of rates.
You and Jan Hatzius will have a fascinating conversation. I believe he also had thoughts about the term premium there. James Athey walking us through the economics and the trade. Thank you, as always. Coming up on the show, our exclusive interview with the European Commissioner for Financial Services. That coming up next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Let's focus now on financial regulation. Bloomberg's Maria Tadeo joins us in Brussels with the European Commissioner for Financial Services. Maria.
Yes, indeed. And it's Mary McGuinness who joins me here in the studio. We wanted to talk about financial regulation. That is a topic that you cover. But you know, today in Europe, the big conversation is Russia now pulling out from that grain deal. What does that tell you, and how concerned are you? Because it seems they're not going back to it.
Well, let's hope that isn't the case, but we're really concerned. And I think at this stage, to re-weaponize food in a world where there are massive food shortages and people are going hungry and dying of starvation, I think the Russian action is reprehensible. They need to think again. I mean, this horrible war is terrible, but to add to that then the global impacts on food security is just unfathomable that that would happen. What I'm also concerned about as I walk into studio is I hear that there's been some attacks on Odessa.
Yes.
So not only denying that they will support this release of grain to global markets, but also damaging the very infrastructure that would allow that happen. So this is a very, very serious development. I think Russia must be pressured by everybody to say, stop, stop, we are. They know our voice. We've been very clear on this. We're doing our own work on solidarity lanes separately to get grain, and we will do everything we can. I mean, if this is what Russia is intent on doing, then the rest of the world has got to, take action to make sure that we get grain out. We're coming to a harvest is happening. We know that in some parts of the world, the harvest isn't great. We know that global food insecurity is at its worst. So we really have to avoid that there are now horrible spikes in price, which will impact the poorest. And we need to make sure that Russia changes its mind.
And Commissioner, let me ask you a follow-up question on this, because today the head of the Commission said this is entirely cynical because Russia says the terms of the deal have not been met for the Russian side. It's unclear what those terms are or the new ones would be. But if this is a move to have sanctions from the European Union east, is that going to happen?
We have been very clear. Our sanctions are there for a purpose. They're there to take away money from the war machine that is Russia. The idea that they would bargain with the lives of people in places where there is no food at the moment, that is reprehensible, and it has got to be called out for what it is. But I would hope, I hope that other countries would put pressure on Russia to rethink this, because if you look at the statistics around global hunger, the disruption of the market we saw after the war was horrendous. Russia tried unsuccessfully to pin that on us, on the Europeans, and on our sanctions, but clearly it was a very deliberate tactic of Russia to hold back grain, to stop Ukraine feeding, as it does, the world, and they're now repeating that attack on the hungry of the world.
But if this is a yes or no question, if this is a way to bargain down sanctions from the European Union, is the answer no? That's not going to happen. These sanctions will not change.
That is not a just and decent bargain. We cannot deal with people's lives. This should never have happened in the beginning. There should never have been a threat to grain supplies leaving Ukraine. The weaponizing of food, the re-weaponizing of food is just something we cannot but condemn. So we will continue to do our work on sanctions because we believe what Russia has done is illegal. It's against everything we stand for. They have to understand that. But we also are supporting where there is global food insecurity through our solidarity lanes. And we would hope that Russia would see the sense and indeed the awfulness of their current actions and reverse this. I see glimmers of hope. Let's see if we do get back to the table. The UN are working really hard on this. Turkey's involved as well. The EU has made its message loud and clear. We cannot allow the world to slip into an even worse food insecurity situation than it is today.
And just a final question on this issue, but again, it really is a topic that has eclipsed the conversation today across the European Union, and this has to do now with third-party sanctions. There's a lot of European taxpayers who say, okay, we sanctioned Russia, we took a massive hit, but what about all of these guys that continue to trade, and they're circumventing sanctions? I mean, that is happening. Do you know who's doing that? How are you going to stop it?
Circumvention shows that our sanctions are working, number one. Number two, I think European citizens are not complaining about sanctions, but they want them to be effective, and they are.
And not others
but
to profit.
Clearly, exactly. In times of war, there are people who will do the most awful, and they profit from war. We are working forensically on trade statistics. We're going on country visits. We have a special envoy who's looking after this. So we are using all of our powers of pressure and persuasion to say you should not be part of continuing
you get sanctioned?
this war.
Would you say that?
There's no point in saying. What we have to say to those countries is recall your own obligation. Do not get involved in something that is, an affront to security and safety of the people of Ukraine. There are those also that we need to understand products. So we've got this entire list of products. So while it's not visible, the work we're doing behind the scenes on trade flows, on financial flows, is very forensic, is yielding results, and the pressure will intensify over the coming months because we are very insistent, and indeed the President, Ursula von der Leyen, has said our sanctions are here to stay, and they will be effective much more over time. They are effective now. Russia is trying to circumvent. We're pushing back on that very strongly.
And you make that message is clear. Now let's go back to your actual portfolio. But obviously, this was the topic, and we had to really handle it today. Sustainable finance. You said you wanted the European Union to be a champion. There's a review that's happening with ESMA. What can investors expect from it? Because some say, is this going to be a big review, a less review, or are the rules changing every year? Do they get the security they need if you want to get into the space?
I think our people who watch what Europe does, we're very transparent. So what we have are disclosures coming from companies on sustainability. Like they show profits, they've got to show sustainability data. We're working on those standards. Investors will have access to that information to be able to make informed choices, which is really important. And we have our taxonomy, which is very clear around sustainable investments. We're leading here, but we don't want to lead only. We want others to come with us on this journey. We are looking at ESG ratings. So how are these calculated? At the moment, it's quite opaque. So we're looking for transparency. We're not telling these companies how to do it, but we're asking them and insisting that they tell us, show how they actually make these calculations. And then we can see whether they are comparable from one to another. And investors can see what's behind all of this. Really, over the last number of years, what the European Union has been doing, I mean, it's quite extraordinary in many ways because profit is important, but we're now saying it's not the only thing that matters. You also have to have a long-term strategy to address sustainability. Companies know that. Big and small companies know that if they don't change, they do not have a future. We're helping them to go in that direction. And the key word is not green or brown, it's transition. Because we have an enormous need for investment in the transition from where companies are today to where they need to be.
And just very quickly, we're running out of time, but if you were an investor here, would you say stick with us, the rules are what they are? Or actually, do you get their point that if we're always going to be under surveillance, why should I put my money there? I'm not sure what works now will work in a year.
I think they should be very happy that Europe scrutinizes everything, that we're very transparent, and we're on a journey which is very clear. And it's not just a scheme for 5 years or 3 years. It's actually a long-term almost revolution in how we look at business, how we actually behave as consumers, where everything matters. So instead of looking like the blinkers on one direction, we're talking about a circular view of both economies, about companies, and indeed about our own behaviours. This is a moment of enormous transformation. So I think investors will stick with us because there are opportunities. And I think that's important as well.
And you're also sticking with your targets on this issue.
We are, absolutely.
Well, Commissioner, thank you so much. I wish we had an hour, but of course this is live television, but we'll continue off camera. Thank you so much. Always good to see you. And that was Mary McGuinness, of course, Commissioner for Financial Services here in Brussels. Freddie, back to you.
Yeah, Maria, today in Brussels, they're covering a wide range of topics, specifically top of mind what the implications are of the grain deal that was broken between Russia and Ukraine. Also top of mind here in the U.S., bank regulators set to release plans next week for an overhaul of capital rules that includes requirements for large lenders' residential mortgages to go beyond international standards. For more on this Bloomberg Scoop and the latest bank earnings, we're joined by Bloomberg Global Finance correspondent Shonali Basak. Walk us through the implications of the residential mortgages specifically. This is a very targeted area.
It is a targeted area, and it's a place where you've seen a lot of activity move outside of the regulated financial system since 2008. So what are we looking at? In the scoop broken by Katanga Johnson over in DC for us, the idea here is not only certain residential mortgages, but also certain types of business loans might have higher risk weightings. Right now, for a first lien residential mortgage, that looks like around 50%. Now it could move from 40 to 90%, and it is bound to face criticism, frankly, in the public comment periods after that July 27th release that you'll see from a group of regulators in the United States. Now, this is part of the Basel III endgame, the global international standards. However, the mortgages are expected to be treated more onerously here in the United States, partially to level the playing field. Remember, there's a wider array of banks now about to face more of these international and U.S. standards. And so the idea here is to make sure that these rules are standardized across the board and the biggest banks are paying their due. But again, the criticism here is a lot of this activity has been moving outside of the financial system already, and it could constrain lending even more at a time where mortgage rates have been going up as a function of higher interest rates already.
All right, yeah, maybe it just moves even more into private players. Shonali, we're also going to get Morgan Stanley and Bank of America earnings out today. What are you looking out for?
There's a couple things here. For Morgan Stanley, we're going to keep an eye on that competitive pressure when it comes to investment banking, trading, particularly in the equities business, where we've seen them compete very heavily with Goldman Sachs and JP Morgan in the last couple of quarters. For Bank of America, it's net interest income. Remember, they haven't given full year guidance yet. We have seen the other big three banks already increase their guidance for the year. So it's going to be interesting to see how the market would take any kind of sense about what they might make this year or even in the coming quarters. And if that will be enough to make the market happy, we'll also be keeping an eye on expenses here. That has been a story consistent across the many banks. Remember, headcount has been kind of volatile across the different banks. We have seen that Citigroup stay stable, but kind of hint that that could be under pressure. We've seen Bank of America make some headcounts. Banks have had some costs tied to severance as well. So will that be impacting Bank of America, in addition to anything else that can kind of erode the bottom line at a time that they're expected to make more net interest income?
So those are the big banks. Let's talk about the regionals here as well, or even the smaller banks. PNC Financial, BNY Mellon also coming out. It feels like the kind of banking turmoil of regionals is something we put in the rearview mirror, yet the earnings are going to be highly scrutinized. What are you watching for there?
That's exactly right. It's not a question of crashes right now. It's a question of profitability and how much that might erode moving forward as well. What does that look like? Remember, PNC is one of the bigger of the mid-sized regional banks, if you will. And so the pressure that we're seeing is mostly in the mid to smaller range. So in theory, the U.S. banks, the PNCs, could be beneficiaries of some of this both deposit flow as well as lending activity. But remember, lending has been under pressure. The expectation here is the mid and smaller sized banks do not fare necessarily as well as the bigger banks that have a different loan mix. And so all in all, the rest of the week is kind of exhausting, Critty. I mean, it's a flush of banks. Many are being paid more attention to the other. Tomorrow's First Horizon and Zions, I'd point to those because those are among the worst performers in that KBW Bank Index. So the question is the sell-off close to being over, and how long does the overhang last for if not?
Honestly, it's so rude to have all these bank earnings in the middle of the summer where we're supposed to be relaxing. Unforgivable. Okay, Shonali, so not a bank, but an asset manager, BlackRock. We had news from them that they would be appointing the Saudi Aramco CEO to their board, which seems like an odd choice given its ESG push. What has BlackRock said about this? Why make the move?
Well, it's interesting. You had an email from Larry Fink to Bloomberg just yesterday talking about the unique perspective that they would get from Aramco on their board. Remember, interestingly, a lot of large asset managers, BlackRock and its large rivals in the passive world particularly, have been making a large push internationally. So this does two things. One, it gives them a bigger foothold in the Middle East, large institutional investors. But to the point that you're making, this is the world's biggest oil producer. And BlackRock has come under tremendous pressure from both sides on their ESG policy. On one side, environmentalists very frustrated that they have not been doing enough when it comes to governance, investing in fossil fuels, when it came to pushing for change in the climate world. And on the other hand, you have another set of pushback from the folks who believe that BlackRock has been too woke in this front. And so to bring here the Saudi Aramco CEO to the board definitely complicates that story.
Yeah, certainly something we're going to be keeping an eye on. Shonali Bastick all over that story. Later today, she sits down with the Morgan Stanley CEO, James Gorman, coming up at 1:30 p.m. New York. Now, we've got bank earnings, we've got eco data, surveillance is up ahead. They're going to walk you through it. Stick with us. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg.
In the eyes of investors, you have a lot of confidence that we've slayed the inflation boogeyman.
I think people have been too negative all year about U.S. economic growth.
The retail trade is still on in full force.
The Fed is going to be able to pause, and it's going to be a function of this inflation data coming down.
What markets are looking to now is what's going to happen in 2024, and it's not going to be 2023 where we see revenue growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly positive on the S&P 500 this hour. Earnings from Bank of America. In the next hour, you'll hear from Morgan Stanley. But so far, so good for an equity market sitting at highs we haven't seen since April of last year. The commentary from the bears sounds a little like this now. Marko Kolanovic over at JP Morgan. A narrow path to a soft landing, modestly wider. This from Jan Hatzius of Goldman Sachs. They've got better confidence that, quote, bringing inflation down to an acceptable level, Tom, will not require a recession. You've seen commentary after commentary from the South side, sounding a lot like that over the last 24 hours.
Yeah, and from the South side, Janet Yellen with our Anne-Marie Horton saying pretty much the same thing, granted with the policy prescription as a public official. I agree the Hatzius news is important, and it's, you know, what I'm calling, folks, rationalization Tuesday is everybody, particularly bears, not Hatzius as a bear, but the bears are rationalizing where they're going. But far more important to me, John, witnessed the Wall Street Journal article this morning, is this partition I've never seen before between these big banks today and in the morning, and also the little banks coming on, the little banks like PNC of Pittsburgh and also Western, whatever it is out in California.
Western Alliance.
Nailed it, thank you.
Yeah, okay. Lots of regionals reporting, lots of major banks reporting as well. Goldman Sachs coming up tomorrow, and some data out there too. Lisa, 8:30 Eastern time this morning. U.S. retail sales, that's going to be a focus as well.
Especially because the expectation is a softening in the discretionary spending. It's supposed to be dominated by some of the more base effects. And one thing that we have forgotten about is, as things have gotten more expensive, people have been more discerning about where they spend their money. So everyone was flying everywhere, but they might not have been buying the expensive Cartier watches, which is the reason why Richemont was having trouble. So perhaps these are some of the trade-offs that people are making, although I'm not saying.
Cruises and not watches, Tom. Cruises and not watches.
I read about it. I don't know. Dana Telsey wrote up Louis Vuitton and said, you know, they're pretty good except for the United States. I mean, I read every word of Telsey's note.
You saw that in Richemont too, you know. A bit softer here in America.
Yeah, a bit softer here in America. And why should we be surprised? And is that okay? And these extremely expensive stocks, I guess they pull back, what, 5-8%?
Well, but the issue is it's not even just China. And I think that really is what we should underscore. With Richemont, it was this belief in what would happen on the heels of China.
John,
but what we're seeing right now is that in the U.S., we are seeing people pull back on certain spending that is discretionary. And we're seeing that across all different income levels. Do we see some sort of reiteration of that today?
There are some trade-offs we need to talk about. Let's talk about equity futures right now on the S&P 500. Barely positive in the last 10 minutes. Just about positive right now by 0.03%. Yields are down again by 5 basis points, 375.40 on a 10-year. Let's sit on the ECB for a moment. Even the ECB hawks don't want to commit to a hike beyond July. TK, I think there's a message in a bottle there over in Europe.
It's a different story, and for Lagarde, a different story, and it is the politics of Europe as well. But I agree, John, that's beneath the radar today. I guess it moved the German market a little bit, the German bond market, the depth of Europe. But I agree. And also note, this, I just looked down here. I haven't looked at least since I walked in the door 10 minutes ago. The 10-year real yield in the United States has just plunged, and I use that word specifically, to 1.5044. A 149 on the 10-year real yield is the same as that verbiage out of ECB.
Push it through foreign exchange. Still, some euro strength. We grind out another one. Let's just sit on this for a second. The euro against the dollar, positive, stronger for 9 consecutive sessions. We close here, right now. That's the longest streak going back to 2004, Bramo. Euro dollar right now, 112.50.
Which is fascinating, because if you have a dovish tone from the ECB, the fact that there is still euro strength suggests something deeper and perhaps stickier. Today, the bank earnings that we were just talking about, John mentioned Bank of America around 6:45 and Morgan Stanley around 7:30. The analyst calls 8:30 and 9:30 a.m. respectively. PNC, Tom mentioned this, they're set to report at 6:30 a.m. Western Alliance after the bell. What I am watching is just which are the winners. JP Morgan, the clear winner year to date with about a 17% gain. Morgan Stanley with about a 3% gain. Bank of America year to date down about 9%. Today, the G20 finance ministers and central bank governors continue their talks in India, talking about the ECB. Klaus Knott over the past couple of hours talked about perhaps July will be the last rate hike for the ECB. A very different tone than just weeks ago, which is what you were alluding to, and giving some support to the European bond market. 8:30 a.m. U.S. retail sales. I am watching how much higher gasoline prices, albeit not that significantly, but just a touch based on a month-over-month comparison. And the fact that you are seeing increased sales in certain non-discretionary areas, how much that's offsetting the underlying fundamental dynamism behind some of the sales.
Elisa, thank you. Packed day ahead for you. The week really picks up this Tuesday morning. Joining us is John Stolfus, the Chief Investment Strategist at Oppenheimer Asset Management. Is the path to a soft landing a lot wider, John, after last week?
It certainly would appear so, Jonathan. When we think of all the capitulation that has happened at many spots across the board from the bears, it looks as a recognition that the Fed is doing the job. The consumer is showing up, even though they've curtailed spending somewhat, and business is being remarkably resilient, whether it's the cost cutting in technology or in other areas. It's remarkable. Everybody seems to be doing a good job at working through what could be a fairly tough transition that's coming out a lot better than had been expected.
John, what's interesting here is not the when of it. I'm going to suggest that you had to struggle through 22 with optimism that it was difficult to find, and now you've hit a home run clearly on a bull market. I'm seeing the bears rationalize. How do the bulls like you rationalize now? How do you reframe from 4x00 up to SPX 5000?
Yeah, we have to stay humble. We have to realize that, in the 40 years that I've been in this business, I've learned one thing: just about anything can happen without enumerating all the things that have happened. Just think of all the different crises that have happened, all the difference in terms of innovations that have changed the structure of economics and doing business, the political structures that have come and gone and returned. It's an extraordinarily challenging period. But it does look, for now, that, business is doing well. Businesses are not deer caught in the headlights, but yet with advanced technology able to navigate challenging waters. We're beginning to see that in this earnings season. knocking on wood, and hopefully we'll continue to on that. But the Fed and central banks around the world, whether it's the ECB or the BOE, have been remarkably sensitive in recognizing the effects of their actions from past periods. And that, combined with a lot of liquidity around the world still out there from fiscal stimulus, is helping float this recovery process.
Well, how do you decide then, John, when to take some chips off the table, when to get a little bit more, not defensive, but at least cash in, given that everybody's joined your party and you've gotten much higher in terms of valuations than we were 6 months ago?
Well, you know, Elisa, there's a couple of things. I think when we look at this, if we all look back and we think, are most things that we buy more expensive today than they were a few years ago? Yeah, they sure are, except for stocks on a broad basis. And the rallies that we have seen in technology and all still have not taken the S&P. Last I looked, the S&P 500 was still down around 5.5% from where it ended 2021. And many of the sectors were much worse off. So it would look, there's a lot more recovery still to happen here. The other thing is, I think an investor has to know, are we traders or are we intermediate to longer term investors? And the intermediate to longer term picture still looks decidedly, if not rosy, it looks healthy for a market to climb a wall of worry. But we're not big on memes. We don't like the memes. We're not big on cryptocurrency, but we like good companies, positive cash flow, profitability, and managements and products that attract investors to them. We like tech, we like industrials, consumer discretionary, and the big bank financials look good to us as we begin moving towards, we believe, what will be a more normalized yield curve.
And we'll get a sense from the big banks coming up, the latest with Morgan Stanley and Bank of America. You mentioned big tech, and I know you are still very bullish on big tech. A lot of people say they want to bet on AI, looking at the companies they're going to benefit more peripherally. What makes you want to double down on the biggest, most popular of the technology giants?
I don't know if I'd say double down, but definitely want, we're not running away from it. It's the innovation that technology offers today benefits all 11 sectors, not just itself. When I got into this business, if you talk technology, it was business, government, and education that used technology mainly. But today, it's deeply embedded in the lives of business, the consumers, and those other groups as well. We're all tied to the upgrade cycle. And while their risks increase in terms of privacy and all kinds of issues that need to be addressed, technology has really brought us to a most remarkable point today in providing a resilience that we believe is reflected in the market. So that's why we still like tech. However, that said, if you look at our weekly piece, even though we rate technology outperform for the S&P 500, we're somewhat underweight versus the benchmark. I can't believe it. I think when I looked at it over the weekend, it's close to 28%. We're at 26 or something like that.
Right.
But for most people, they have to really judge what their exposure will be. But think of all the sectors like industrials that are positively affected going forward in terms of innovation and all that's happening within chip onshoring or the business of infrastructure build and around the world.
Right. John, you're very top down. And most of the people surveillance talks to are all top down. I want you to talk about the heritage of bottoms up among the security analysis of OPCO. And I'm going to go back to the giant Myron Picot, who we all worshipped and read every damn word of on the Insurance Act. What's the value right now of reading bottoms up security analysis to rationalize your top down belief?
Well, I think the important thing is to recognize valuations relative to where they have been historically, not just in recent history, but longer term, and then compare it to periods where you had extraordinary innovation, and then to recognize how an analysis has been affected by technology. I can remember years ago when I was at Mike Wilson's firm. I used to work at that firm without mentioning the competitor. At that time I was working at 1585 Broadway, if you know the address.
Give us the zip code. We need the zip code.
The technical analysis, the technical analysts there at one point were still putting up large pieces of paper on glass windows that surrounded their offices to draw up their charts. Today, everything is instantaneous. You know, you can put things together, back test, forward analysis, and technology has made a very big difference in terms of Wall Street. And it's reflected, I believe, in the resilience that's shown from maximum drawdowns. If you do the comparisons from the 1970s into the 1990s to today, it's fairly remarkable, and it affects the way the Federal Reserve operates, but it most certainly affects the way corporations respond to situations. And we think when trouble shows up, it's the quick response that makes the difference. It doesn't mean the quick response will be correct, but the quick response can often, it's the first response, and then you keep tweaking it until you get it right.
John, we can do it together. Therapy session. Morgan Stanley.
Let's
we can say it.
Let's get Mike Wilson, John Stolfus together.
Morgan Stanley. John, thank you, buddy. It's good to catch up.
John,
Congratulations,
John.
Of Oppenheimer. Difficult year last year for John. Much better year in 2023. He's been confident this equity market would perform. This stock market so far this year has performed.
I want to go back to the 2 to 4 second quarter. Lawrence McDonald writing up in his Bear Trap report, he talked about the great hijacking that is out there. And that's what we're coming up on in these tech earnings. What will the hijacking stocks do?
Well, the bulls have hijacked the narrative big time.
Yeah. What's this hijacking going to look like into August?
Next hour, Amy Wu Silverman of RBC from New York City. Good morning.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. Season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging, that we're making progress on getting inflation down.
Janet Yellen on the conversation in a moment, validating the soft landing hopes and dreams. The Treasury Secretary catching up with Bloomberg's Anne-Marie in the last 24 hours. We'll touch base with AMH in about an hour from now. Jan Hatzius at Goldman Sachs making a move. We're cutting our probability that a US recession will start in the next 12 months, further from 25% down to about 20%. The main reason for our cut is that the recent data have reinforced our confidence that bringing inflation down to what they call an acceptable level will not require a recession. Heard something similar from Seth Carpenter over at Morgan Stanley, Tom, and certainly the equity market bulls so far this year feeling validated by the data of the last week. Let's see if it continues through this summer and beyond.
I go to retail sales at 8:30, John. I think it's really important. These are reported nominal. So if inflation's coming down, maybe retail sales are in some way a little bit light and coming down, and that's the indication that we heard from the secretary in that interview with Anne-Marie. But there's got to be a numerous set of indicators to say that inflation's coming down, and they accumulate, is how I'd put it. That's all there is to it. Joining us now to synthesize the moment is Kit Jukes. He's Chief Foreign Exchange Strategist at Societe Generale. He writes, John, what would you say, 2 paragraphs?
No, 3.
I mean,
he writes 3.
Is the tea even steeped before he's done
3
writing?
paragraphs, Tom.
Kit Jukes joins us now, the king of the 3-paragraph morning note. Is it hard to keep it concise right now, Kit? Are you overwhelmed by complexity as identified by the foreign exchange market, or is it a simple story?
It's quite complicated, but in a sense it's simple. You have to keep it simple. It's simple because everybody has taken a few pieces of economic data in a very confusing world and has latched onto this soft landing story and is embracing it, and they're selling the dollar, which has gone up a long way, and they're buying everything else back, except for the Chinese yuan, which they can see the problems with, and that's kind of what they're doing across the board. So we've got a simple reaction that's replaced what we've been doing all year, which was just trading foreign exchange off the next interest rate decision by the Fed, the ECB, and Bank of Japan, and whoever. But we are going all in pretty quickly on this soft landing.
The soft landing identifies to a weaker dollar. Can you suggest that you can get big figure moves out of any given pair, out of DXY as a traditional index, out of the Bloomberg Dollar Index, BBDXY? Is it a big figure scope, or are the compensating factors so real that it's a sort of a nudge along a line into 2024?
I think we can go back. I would think that we will struggle to get the DXY to fall by another 5% from here, but it could fall the best part of that. We could go back quite easily to close to the kind of lows we saw at the end of 2021 when the Fed had been really accommodative and we hadn't started talking about the Ukraine war or talking much about policy normalization. We could go back to those levels. In other words, where we were when we were recovering from COVID, but weren't talking about Ukraine.
There was an interesting test this morning. Some people speculating that the reason for the euro strength and the dollar weakness was because the ECB was much more hawkish. This morning, it seems like there is a decidedly more dovish tone out of ECB members, with Governing Council member Klaus Knott saying, for July, a rate hike, I think it is a necessity. For anything beyond July, it would be at most a possibility, but by no means a certainty, a very different kind of tone. Are you saying even if the ECB stops raising rates past this month, we will still see euro strength and dollar weakness?
We should do. There's one caveat on that. What we've got at the moment is a market that's pretty optimistic about how the US economy is looking and still pretty pessimistic about the way that the European economy looks. So we need the European data at a bare minimum not to get worse, but preferably to continue looking as if we're going down a path towards economic recovery and not over-embrace this kind of story of Europe's in a mess and the US is all good, because that could push us further. I think, whether the ECB's finished or not, I suspect, it's a big council. There's got a lot of speakers. You haven't heard from Lagarde for a few days. We'll get both sides of that argument as we go along before we're done. But yes, the euro can go up just on a rethink of some of the negativity around the European economy.
I love that. We're sort of at the day-to-day kind of level that because we haven't heard from Christine Lagarde for a couple of days, suddenly that means that perhaps something might have changed in the past couple of days, John. I mean, that's sort of what the implication is that every day is a new message.
I felt like that was a subtle dig at the ECB president, then, Tom, about the frequency at which she speaks. Going beyond September, let's just go back over the last 12 months. I never expected them to get to 4% on rates at the ECB. Did you?
No, we've all gone. I mean, these aren't. We're old enough that these aren't historically high levels, but we have gone up quickly everywhere. I think that's the piece you would say. Further, I didn't expect to get to where we're ever going to get to in the UK either. But that tells you that we're trying. It tells you the strength of the global economic recovery thanks to the monetary accommodation and even more the fiscal accommodation we got in the last couple of years. The global economy came out of the pandemic with a lot of momentum coming through to it. A lot of people had a lot of places to go, a lot of planes to catch, a lot of beers to drink, a lot of parties to have. And we got out and we got on with it. And then that got its own momentum. And in a sense, that's both the danger and the positive. That gives us momentum. The danger is, we're spending pent-up demand. We're spending for what we missed. And one day we'll run out of desire to do so, and we'll run out of money. And then we'll have to see how soft the landing.
Kit Juice, SocGen. Kit, thank you, buddy, as always. I remember Chris Harvey of Wells Fargo calling it spring break for adults coming out of the pandemic. And Tom, if you look at what's happening with the airlines and what's happening with the cruise lines, it still feels like spring break for adults.
But again, it's Rationalization Tuesday here. And just to point out here, someone like Chris Harvey has been incredibly supple, adaptable, amenable week to week. And the people that are rigid right now, both long, both short, whatever the belief, they're the ones suffering. I give the highest marks to someone like Chris Harvey. Luke Kawa, too, has been that way.
Luke's very cool. Citi.
Well, he's okay. He's not cool, but with a dog like that. I mean, his dog is cool. He's not.
Okay, that's the assessment on Kawa done. Yeah. Citi, as I was saying, out with the pushback on the soft landing optimism. Veronica Clark's going to join us very quickly. The team with Andrew Hollenhorst saying that optimism might be premature, that inflation could well reaccelerate going into the end of the year and coming out of 2024. I just wonder how useful that call is right now for anyone who wants to put on the trade, because in the words of Mohamed Al-Arian on Friday, this is a narrative at the moment that he doesn't think you want to fight, Tom, in the equity market, cross-asset for that matter, because so many people are on board with this idea that we can land this plane softly and avoid a recession.
Yeah, no question, to get to where Hollenhorst and Victoria are, the only way to get there is data. And if the data swings the other way, I mean, that would be stunning given the glow that's out there right now. It's
more data in about 2 hours and 5 minutes. Look out for that. US retail sales just around the corner. Claims as always later this week. The data's pretty light this week. Light on the Fed speak. You won't get any. As we said a few times in the last day or so, it's the quiet period for the Federal Reserve ahead of their meeting this time next week, their decision a week tomorrow. All the earnings you get through this morning. Bank of America a little bit later this hour. Should come in about 20 minutes time. Then it's on to Morgan Stanley in the next 60 minutes or so. Then after that, you get Goldman Sachs on Wednesday. Goldman Sachs over the last couple of weeks just feels like the South Side.
What a mess.
Media commentary has set the bar so low going into earnings from David Solomon and the team. This is what equities look like going into those results from MS, from B of A a little bit later. Equities totally unchanged on the S&P 500. Talked a lot about the ECB with Kit. That sparked a bond market rally in Europe. It carries over to the Treasury market. Yields are lower by 4 or 5 basis points. Your 10-year, 375.79. And there it is again. For a 9th time, the euro stronger against the US dollar.
Connection lost.